So what I find so interesting is that Trump 1.0 had talks with TSMC. They wanted them to come to places like Arizona. They wanted to put some production of semiconductors back in the United States. But Speaker Johnson was asked recently, actually in New York, when he was on the campaign trail for representative, would you try to roll back Biden administration's CHIPS Act? I think he just heard Biden and said, yes, we're getting rid of it, and then had to come out and say, actually, we're not. Either way, the Biden administration did this in a bipartisan fashion. A lot of work went into this from Gina Raimondo, and they want to make sure that these companies get that money, get those grants, so they can make those chips in the United States.
China is at the epicenter of so many of these conversations. China is preparing for another Trump administration, announcing a $1.4 trillion debt swap to help local governments as it tries to support an already slowing economy facing new risk from Trump's re-election. China's President Xi Jinping sending a congratulatory message to Trump and said a healthy and sustainable relationship is in the common interest of both countries. Peter Chia of Academy Securities joins us now for more. Pete, welcome to the program. For this relationship,
Thanks very much.
Are you focused on the economics of all of this, or are you focused on the broader foreign policy? As a market participant, what matters more to you?
You know, I think they're very entangled, right? I think with China, when we talk about this at Academy Securities, we talk about the four levers of power: diplomacy, information, military, and economic. And as China is our main competitor, there is going to be economic competition. I think there are going to be peaks and valleys where it gets more or less tense. How we've been looking at it is there are going to be certain things that are just sacrosanct, whether it's chips, technology, AI, and there's going to be very little to no grounds for kind of movement with China. I think there are opportunities within the regular sphere of business to do things with China. I think the tariffs are a threat to bring them to the table, and we'll see where all that goes. But yes, we are going to be at an economic kind of Cold War with China, and that's not going to change once Trump takes office.
So, Pete, you think they open negotiations before they fire shots? And by shots, I mean tariffs when they walk back into the White House.
Yeah, I think he's going to announce the potential for tariffs, and he's going to want to see how China responds. That's his behavior, right? Even when they did the first round of tariffs, I think we almost have to go back to 2018, those first rounds of tariffs. One, it built up over a period of time, right? So there were talks, there were to and fro, markets were reacting to that before he finally pulled the trigger and put them in. And also, if you remember, there was almost universal hatred of the tariffs, right? Almost every single economist that I know came out and said tariffs are awful, trade wars are bad. Turns out maybe they weren't so bad. And right now I'm hearing a lot of this, oh, protectionism fails, you can't do this. Well, China's been running a protectionist economy for 30 some odd years, and they went from nowhere to a real powerhouse. So we have been in a trade war for a period of time. I think the gloves are off. We are going to try and figure this out. I do think, though, the CHIPS Act is going to be, or some version of it, is super crucial. That is something we need to do a much, much better job of manufacturing domestically.
So if the tariffs aren't necessarily going to be as extreme or as quickly implemented as maybe fears initially were, that at least were expressed through the bond market, then what comes next? I mean, if the tax cuts can basically be extended, and that's basically the assumption in markets, doesn't that kind of tip the scales on the inflation, on the growth side of things that I think equity markets are waking up to?
You know, I think when I look at the tax that was getting extended, it seems incredibly likely, right? So I think it's going to increase the deficit, but a lot of that's priced in. I'm not sure that it does a ton for growth. I don't think anyone's been sitting there trying to figure out their expenditures based on higher taxes. I think most people kind of assumed on that. So I don't think you're going to get a big economic boost from the tax cuts, maybe something if it happens on the corporate side. I think that's more just the status quo. But I do think the bond markets got ahead of themselves in terms of worrying about deficit. Inflation, yeah, it could come back. We're seeing elements of that. And I do think we are probably going to see difficulty getting much below 2%, 2.5% even consistently as we try and, build onshore refining, right? As we try and do a lot more of this resupply, I think Trump is going to do a very good job. I think one thing that's been lacking in a lot of the last 4 years as we've been trying to move towards sustainable and self-dependence is not in my backyard. Not in my backyard has stopped a lot of projects. And I think that's one area that Trump might do a good job of, is looking at some of these rules and saying, hey, those were important. They were put in place, but they were put in place where we're not really in a global economic competition with China. Now that we are, let's rethink some of these. And I think this time, as the previous guest mentioned, he is surrounding himself with some good advisors who he does seem to listen to.
Given the fact that people do think, and equity markets seem to be suggesting, if not a full throttle growth shock, something that looks a little bit like it maybe on a tempered scale, there's a real question of what the Fed's response will be to that. And I wonder how much you look at long end yields coming down as part of the consequence of Jay Powell potentially opening the door to not cutting rates again in December.
Yeah, I think Powell handled it very well, and I completely agree with him, right? People got ahead of themselves and, well, what will this policy do? What will it look like? It's going to take months for this to even start playing out. I don't even know what will get done in the next year. I do think a lot of it was a negotiating ploy, and a lot of it will be very difficult to implement. So, yeah, I think Powell held the line, said, hey, we will look at this. We will judge it as it becomes policy. And so bond markets have got way ahead of themselves. I think, again, this has been flip-flopping. Just when we probably should not have been at 370 or 380 a month ago on 10s, we probably should not have been at 440. I think 410, 425 is a good range until we find a little bit more policy definition there and see real signs of inflation.
Peter, can we just go back to China for a moment? As we read the tea leaves coming out of Mar-a-Lago about who's going to get what key position, Robert Lighthizer was a key architect of the aggressive tariffs of Trump 1.0. What would be the difference to markets if he becomes the Treasury Secretary, or potentially he just has a more of a niche trade portfolio within the West Wing?
You know, I think Treasury Secretary is going to be important. I'm not sure that the market would like that. I think they've accepted what he does on trade. I'm not sure that they would take him in that broader response, but that's going to be an interesting, role to fill out. And again, I think there's going to be a lot of, ooh, that's interesting. Ooh, that's a bit scary. And I think that's just something we're going to have to digest. The one thing I've been trying to say to people, and I'll probably do my weekend note on it, is, if only AI had a good way to actually translate what Trump says into what he likely means, and even more importantly, what's likely to go policy. So that would be a great AI app, I think, someone to figure out.
Maybe Elon Musk can. So would Robert Lighthizer be a, ooh, not so good, and maybe Scott Bessent would be like, oh, we can handle that?
I think markets are going to handle it until they see real policy come out, how people respond. Again, I think we're all just digesting, okay, he is now in charge, and we've seen this kind of, circle of people that have surrounded him through the election. I think people have adopted a view that, okay, this circle of people seems much more involved, seems better organized. Now we'll have to individually figure out what that broader circle is going to look like. So I don't think there's going to be any panic. And I would argue, I think, maybe push back a little bit, Lisa, that I don't think it's necessarily we're seeing a growth spurt, but I do think we are seeing people say economic slowdown is likely off the table, right? Trump will work very aggressively, especially with the House and Senate on his side, to ensure that we do not get a bumpy landing. So I think that really is what's being taken off the table this week, more so than just an outright growth opportunity.
So, Peter, do you agree with Mohamed El-Arian, who sees this economy as bigger, but not necessarily hotter?
Yeah, I think it's going to be more broad, right? I think that's one reason you've seen some of the Russell 2000 stocks do well. And again, you're getting a little bit of reversals in all these trades, but I think there really is this opportunity for more domestic growth, for jobs to be created, for industries that maybe, have not been the be-all and end-all lately to do better. You are seeing rates coming down. A lot of the smaller companies do rely on floating rate financing. So, yeah, I do like this trade, and I'm starting to look really closely at commercial real estate. I've been on the teetering about really wanting to highly recommend that. I think that's going to be great. I think you're going to see a lot more work from office mandates coming from companies, and the U.S. government is still actually very much work from home. If you're talking about efficiencies, having a bunch of people not use the office space, that's probably one of the most inefficient things, and that seems like an easy thing to solve, right? Start mandating 3 or 4 days a week back in the office. Government employees, you see DC's commercial real estate do better. So I think commercial real estate is going to be one of the benefits of this. And let's not forget, that's the one thing Donald Trump says he understands is commercial real estate. He loves it. So I see no reason for him not to push policies forward that will help that.
Hey, Pete, that's a great call, because anyone that goes down to Washington, D.C., ghost town. Peter Chair of Academy Securities. Peter, thank you. And shout out to Peter. Tuesday night, bond markets start selling off. Peter Chair on Bloomberg TV. I think you should buy bonds here, which was a brave call at the time. DC is a ghost town. You know this well. If someone came out and said, let's get back to work, get back to the office, that would be a big shout.
The businesses and restaurants in Washington, D.C. would be very happy. I will say, when I first moved there, it was still the end of the pandemic. Everyone was working from home. It felt dead. It's gotten a little bit better, but still, a lot of these federal workers work from home. That's not going to fly under Trump 2.0.
All I could say is I actually got a lot of notes about commercial real estate yesterday. If there is anyone that is going to help commercial real estate, it is probably someone who has made his money completely in commercial real estate. And you have to imagine some of the policies that are going to go into place.
Make Washington great again. I think that's...
Is that the goal?
I think that's what his goal is, yeah.
Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Dutch police arrested 62 people after authorities said rioters attacked Israeli supporters following a soccer match. The violence was condemned by the leaders of both the Netherlands and Israel as anti-Semitic. Israel's national airline said that it will offer free rescue flights from Amsterdam to Tel Aviv over the weekend. Argentinian President Javier Milei will meet with U.S. President-elect Donald Trump and Elon Musk next week at Mar-a-Lago. Milei voiced support for Trump after his win on social media. He's tried to forge closer ties with the U.S. since taking office last year. Meanwhile, the Conservative Political Action Conference is set to kick off next week, also at Trump's Beach Club. AstraZeneca is no longer the UK's biggest company by market value after a dismal week. Its market valuation dropped by over $27 billion this week, with ongoing investigations in China over alleged illegal imports of cancer drugs and privacy breaches. That's also on top of another investigation in China over medical insurance fraud. The stock has lost about a quarter of its value since reaching a record high in early September. Now, oil giant Shell has retaken its spot for the UK's largest company. That's your brief. John.
Danny, thank you. More from Danny in 30 minutes. Up next, emerging markets bracing for tariffs.
This is going to be long, and it's going to be messy, and it's going to be inflationary. It's going to be targeted at China, but Mexico is going to take the brunt of it.
That conversation up next.
About artificial intelligence. Is artificial intelligence going to enable you and others to say we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Equity futures up 0.1% on the S&P 500. Bond yields just a little bit lower, down 2 basis points, 430. Under surveillance this morning, emerging markets bracing for tariffs.
It's all going to be about tariffs, tariffs, and more tariffs here because he can move very quickly. I'm thinking like day one, week one quickly. Be prepared for big-time tariffs that he promised. 10 to 20% across the board. This is going to be long, and it's going to be messy, and it's going to be inflationary. It's going to be targeted at China, but Mexico is going to take the brunt of it.
So here's the latest. Mexico in focus as President Claudia Sheinbaum says she spoke with President-elect Donald Trump about trade relations. Trump's re-election could leave Mexico and other emerging markets looking vulnerable. Dan Tobon of Citi saying President Trump's re-election is dollar positive. We think the dollar could approach the top of the 2-year range on tariff, trade war concerns and relative growth outperformance. Dan joins us now for more. Dan, welcome to the program. I just want to start with EM quickly and pick up on that line from that last speaker, Heidi Krubo-Rediker, who said those tariffs are going to be targeted at China, but Mexico is going to take the brunt of it. Do you agree with that assessment?
Well, it depends on the timeline because Mexico under USMCA has some coverage from tariffs. And initially we think the more rapid tariffs are the ones that will come under Section 301 and Sections 232, which would more likely be very targeted towards China. When Mexico is going to be a little bit more vulnerable is when the USMCA comes up for review in the summer of 2026. So we think if there's an order to this, it's China first for this year, and then Mexico for next year, and that's probably also in line with how we would think about the congressional side of things, right? These broad tariffs, which are being discussed, those probably need congressional approval versus the country-specific targets, which could happen a lot faster. So, I think it's China, then maybe these broad ones, and then Mexico into next year.
So maybe dollar strength, but not necessarily to the moon, not necessarily continuing a trajectory of what we saw in the immediate knee-jerk aftermath of the election. Is that right? I mean, basically, have we seen almost the bulk of the moves already?
Maybe we've seen about half of the moves, we would say. The way that we think about it is, you look at 2016, Trump won, and it was a surprise to the markets, and the dollar rallied around 5%. You look at 2020, the markets thought that Trump had a good chance of winning. They built in some premium for him winning. He didn't, and the dollar fell about 4 to 5%. The question here is how much of this dollar rally that we've seen so far over the last month and change is a function of the elections versus just the relative change in expectations for the Fed versus the ECB. We would say it's probably half and half, which means only about 2% of this rally, of this 4% rally over the last month, is Trump, which means we probably have another 2 to 3% to go to really fully price in all of the potential policy impacts on the dollar.
You talked a lot about how a lot of these tariffs are initially going to be focused on China and that Mexico later on during the USMCA could get hit. Is that the reason why we saw some of the Mexican peso strength in the immediate aftermath of the election, completely defying what everybody was saying as a proxy to the potential Trump win, was selling the peso?
I would say that probably has more to do with positioning. We've seen a very steady weakening of the peso, regardless of anything else going on in markets. And so, the way that these elections work, these are very big, known events. And what you have historically seen is a lot gets priced into the options market and volatility markets in expectation for the event. So dollar MEX volatility, for example, was through the roof, record level highs and an expectation of the move. Well, what happens when you get the event and you don't realize the move? The volatility comes off very, very, very sharply. That actually helps support the risk asset, that the volatility is being placed on, and that allows some positioning readjustment. The real question is, will this continue or not? And it's tough to say. We certainly have some more concerned. Our EM strategists are a little bit more concerned on the MEX side, just because this is still going to be an issue in the coming years, but the carry is also still very attractive, so you probably see some opportunistic buying now that the big event has passed and a lot was priced in.
Dan, in terms of the path to tariffs, why do you think Donald Trump will go to Congress when he can just use Section 232?
Well, for these broader kind of big picture, everyone's getting tariffed, it's a lot easier to do it through Congress. These sections from both 232 and 301 do have some limits as to how easy and how broad you can apply them. So I think it's that's usually the way these things work when you're talking about the much bigger trade deals.
Dan, I'd like your view on what I think might be a harder trade, the euro. because I think the Germans just introduced some two-way risk in the last couple of days. The prospect that we get an election and the winner ultimately introduces some fiscal loosening, maybe some debt issuance out of Germany, just a little bit of stimulus. Maybe I'm getting too excited here, Dan. Just frame it for us. Is there some two-way risk now in the euro?
Maybe a little too excited. Look, I think it's more of an option, right? Like, it's either going to be the same exact outcome where there's not really that much more room for fiscal, or some potential smaller loosening relative to the size of the structural headwinds that Germany's facing. It probably won't be enough fiscal to really move the needle that much. These are some bigger issues that Germany's economies are facing at the moment. Certainly, it would be a good sign. And also what it could mean for Europe. Do we see broader loosening fiscally? That could be something that could start supporting the euro. For now, I think we'll just have to wait and see. The structural weakness story still remains more impactful. And don't forget, when we think about tariffs, Europe's bilateral trade surplus with the U.S. is one of the biggest in the world.
Yeah.
So Europe is one that could actually be hurt the most. And in G10, we have been saying, look, euro is the easier tariff trade in the developed market space, and you actually saw that in an election that euro was the worst performing currency as it became clear that Trump was going to win in the G10 space.
Dan, it's good to see you, sir. I always get too excited. Yeah. Dan Tobin of Citi. Not usually about Germany, though, and Europe. Usually I'm pretty downbeat about that.
Calm down. Just because they said fiscal, calm down.
Great. I can still go on vacation next year. Coming up next, Mohammed Al-Aaron of Queen's College, Cambridge, Adam Posen of the Peterson Institute, Stephen Cook of CFR, and former Kansas City Fed President Esther George, the second hour of Bloomberg Surveillance. Up next.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. The countdown is on. everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
In the near term, the election will have no effects on our policy decisions.
I think the markets are going to be a great barometer for what policy needs to adjust to.
So we need to gain clarity on a number of things. Trade and tariffs will be really important.
The devil will be in the details, I think, both on trade policy and fiscal policy.
They don't know exactly what the policy will be, when policy will change, how it will affect the economy, and that is going to matter.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Redefining the outlook for 2025. Equity futures on the S&P 500 pulling back by 0.1%. That's the S&P. On the Nasdaq 100, just a little bit softer. Through Thursday, all-time highs on the S&P, on the Nasdaq 100, record highs through the week so far, and heading towards the biggest weekly performance of the year so far. That's the equity.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Exact margin the Republicans will have if they are able to sweep when it comes to the House. It could be as close as 218 to 217, but Bob Casey of Signum joining us last hour thinks it's going to be more like 219, 220. These are very slim margins. I think if it was any other individual in the White House besides Donald Trump, you would have everyone walking around like they're king of the castle, king of the hill, literally on Capitol Hill. But it looks like they are ready to come in with almost a mandate of what he promised on the campaign trail. But the tax policy is really going to come into focus at the end of next year because that's when TCJA expires.
It's not said and done yet. Still need to work out how big these margins will be, what kind of guardrails we'll see, and whether they'll come from Washington, D.C., or whether the restraining force will come from the bond market itself.
That's the reason why people are focused on bond vigilantes and just how much you could see them come back. One notable thing about yesterday was Jay Powell talked about how inflation was a bit stickier. And Mohamed El-Erian was the person who came out and said, this seems like a single mandate Fed focused on the labor market. And yesterday, I would argue, this became a dual mandate Fed once again, really putting emphasis on the CPI report that we get out next week.
Mohamed joins us in just a moment. Joining us on this program for the next 60 minutes, we'll catch up with Mohamed El-Erian of Queen's College, Cambridge, as Wall Street posts its best Fed day of the year. Adam Poston of the Peterson Institute on why he sees rate hikes coming sooner rather than later, and former Kansas City Fed President Esther George on defending Fed independence. We begin this hour with stocks sitting near all-time highs, the S&P 500 approaching 6,000, notching its 49th record so far this year. Equities heading towards their best week of 2024 as Trump takes back the White House and Chairman Powell continues cutting interest rates. Joining us now, Mohamed El-Erian of Queen's College, Cambridge. Mohamed, welcome to the program. I know you watched the news conference, so let's start there. What was your takeaway?
So 3 takeaways, John. One is, as expected in terms of the characterization of policy, a desire to maintain optionality. And then where I really felt for him, John, is not in his response to the questions vis-a-vis the president-elect, where Powell, the lawyer, came out very strongly. It is this sort of muddled view of what is going on and inability to pivot forward. So think of his responses to the question of decomposition of the bond yield. Think of his characterization of real wages. Does he want them higher? Does he want them lower? Think of his characterization of the labor market. And then that key question by Mike McKee when he said, you've looked backwards, what about forward? And Powell ended up talking backwards. And you get very strongly a couple of feelings, certainly I did, where I felt for him. One is he's become totally hostage to data. And two is that he is in this world of the 70s and 80s where once you are away from the extremes of really high inflation or the threat of deflation, that somehow he believed monetary policy can fine-tune outcomes. And we know that if you over-rely on demand management to fine-tune, you end up with all sorts of collateral damage. So I really felt for him, but not for the political reasons that most of the media is covering right now.
So, Mohammed, you've said this a few times, the lack of a strategic underpinning. Could you just provide some clarity on what you think that underpinning should be? Given the lack of clarity we have about the so-called trifecta down in Washington, D.C., what policy might look like, the margins they'll work through, to get that clarity for 2025 and really to sit there in December, which I think we all agree is the much harder meeting, to make a decision on interest rates and to provide forecasts?
It shouldn't have been a harder meeting, John. It shouldn't have been a harder meeting because there was great clarity back in July, and you and I talked about this, that it was time to start reducing rates, that he could have done it 25, 25, 25. We were a distance from most estimate of the neutral rate, which is somewhere in the upper threes, I think, and there's a distance to go. And you reduce the restrictiveness of policy. Instead, we got no change in July, 50 in September, then a sense, you know what, 50 was a mistake. We got the 25, and now, as Lisa pointed out, probabilities are changing vis-a-vis December. You know, this is not what policy should be doing, but this is what policy ends up doing when you are excessively data dependent. You have a path towards closer to neutral. You have reasons why you should pursue this. And if the election promises tend to end up to be reality, then you could change your strategic view. But as he rightly said, we don't know how much of this will end up being actual implementation.
His strategic view, Mohammed, seems to be let's cut by 25, as they just did, and then maybe 25 again in December. And then the question really becomes a blank slate. He said that they will have more data to really make that assessment, putting the focus much more on CPI. Do you think it was a mistake for him to reintroduce the emphasis on the Fed's mandate of inflation after basically kicking it to the curb and focusing simply on the employment picture?
Yeah, it was such a confused discussion. I mean, he was pushed on core inflation 12 months because he had only focused on headline inflation, so the 2.1 versus 2.7. So he got a question, what about the 2.7 that you haven't mentioned? And then we got into the discussion of, is it 12 months? Is it 3 months? Is it 6 months? He himself previously had said, look at the 12 months number. Now we look at the 3 months number, the 6 month number, just like we went through so many definitions of core and super core and everything else. I mean, yes, he added confusion when there's actually little need to add confusion right now on that issue.
So what do you think the Fed should be doing? If ideally, if they were going to have a framework, what framework should they follow? And I say this as Jim Bianco over at Bianco Research says that right now, to cut rates again might be worse than transitory.
So I don't agree with that. I think that we are a distance away from what the neutral rate is. I think that inflationary expectations are relatively anchored, not at 2%, but you know my view that 2% is too low, and certainly now is too low an inflation target for this economy, unless you want to structurally weaken it in a significant manner. They should be on a path of, until we get significant new information on what's ahead, I stress what's ahead, we will be on a path for now of maintaining a 25 basis points cut. And the other thing I have stressed, it is time to get out of this framework they have, this mindset they have, that they're the only game in town. They are not the only game in town. They should leave center stage right now and become more of an observer and wait to see what plays out. But, you know, once you are on center stage, you've been the only game in town for so long, it is really difficult to exit stage left.
So, Mohammed, that's your advice to the policymaker. Is your advice different to a market participant? Because markets, as you know, are anticipatory. The Fed, you've suggested, is overreactionary. So I want to understand from your perspective now what you would say to a market participant, whether they should be pricing in a big positive growth shock that could come with some additional inflation.
So I'll tell them the direction of travel is clear. More growth, slightly higher inflation, a higher public sector borrowing requirement, and a huge sucking sound where a lot of foreign capital will end up in the US. That is the direction of travel. What you've got to figure out, and it's hard, and that's why we've got a market, is the magnitudes of these things. But I think, John, the direction of travel is clear. The magnitudes are going to become clearer as we get firm indications, not only of what the policy proposals are, but who's going to implement these policies. The appointments are going to be very important going forward.
Couldn't agree more. Do you think this could be a bigger problem for the rest of the world than it will be the United States?
Oh, absolutely. This is a period in which U.S. dominance of the global system is going to increase, both for positive reasons and for negative reasons. In the short term, the rest of the world simply cannot build enough pipes around the U.S. They're trying, and they've been doing it, but these pipes are very small compared to the size of the U.S. Over the longer term, you will see more pipes being built around the U.S. at the core of the system.
Mohammed, the journalists yesterday in the press conference get A for effort for trying to get Jay Powell to talk about politics, but he wasn't going anywhere near this. Do you actually have concerns about the independence of the Fed?
So I would have gone even less. I mean, he gave the legal response. This was Jay Powell, the lawyer, coming out in a very strong way. If I had been him, I would have simply said, I'm not going to discuss this issue. I wouldn't have said no. I would simply say I would not have discussed this issue. Saying no opens up a whole new host of things.
Do you think saying no was hostile to the former president, going to be future president?
I think it wouldn't surprise me if it's viewed as hostile. I think what Chair Powell was trying to do is give the legal answer. However, it can be easily viewed as hostile, yes.
Based on your view of the U.S. gaining that sucking sound of capital away from the rest of the world, do you think that sucking sound will also go to finance the deficit in a way that really caps off yields, that doesn't really allow them to rise as high as some people are threatening, such as 5%?
Yes. I mean, so there's two interpretations of why yields came down. One is the market has revisited. The other, which I favor more, is that U.S. bonds relative to the rest of the world became really cheap, and people reallocated away. If you look at what happened to the differentials vis-a-vis the rest of the world, U.S. bonds in relative space, and most of the time, as you know, Lisa, this market solves in relative space in the advanced world. It solves more in absolute space in emerging markets, but in the advanced world, they tend to solve in relative space. And relative to other advanced economies, the U.S. yields were looking very attractive.
Mohammed, it's wonderful to catch up with you, sir. We're lucky to get some time with you. Next time, I'm going to ask you about a vacancy that might come up at the Federal Reserve in a couple of years' time. And we can talk about that another time. Mohammed, appreciate your time. Mohammed Al-Arian of Queen's College, Cambridge. I think you know where I was going with that, Bramo.
I think he did too. I think he was like really glad you didn't ask me about that this time around.
Might be a space at the Federal Reserve, maybe.
2026?
Yeah.
January?
I think there's a man who's not getting extended.
Yeah, I think that's correct. Do you think that this is I wonder what the mandate is for the person. I think that there are some other candidates.
Jay Powell, I think, will serve out his term, but he is not getting an extension.
Absolutely not. Not based on the last 24 hours. Anyway, that's for sure. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A rapidly growing brush fire in the Los Angeles area is burning out of control. The mountain fire has destroyed homes and triggered evacuations northwest of Malibu. Governor Gavin Newsom declared a state of emergency in the Ventura County. The mountain fire is one of a handful of blazes that sparked in California this week after the outbreak of seasonal Santa Ana winds. Shares of Expedia, those are rising nearly 4% in the pre-market. It reported better than expected gross bookings in the third quarter. Customers booked a total of 97 million nights on Expedia's travel websites. That is a beat of expectations. It also raised its full-year guidance, hinting at a stronger demand into the holiday season. Separately, Expedia announced that its chief financial officer, Julie Whalen, will step down after a successor is appointed early next year. Tesla is now offering a lease option on its Cybertruck. Prices will start at $999 per month for 3 years for customers who put down $7,500 down. The EV maker introduced a lease option after working through the truck's back orders. Last month, Tesla told investors the Cybertruck was the third best-selling model in the U.S. in its last quarter. That's your Bloomberg Brief. John.
Danny, unreal. Appreciate it. We'll catch up with Danny in about 30 minutes again. Up next on the program, a Trump win, clouding the outlook.
We don't know what the policies are, and once we know what they are, we won't have a sense of, when they'll be implemented or all those sorts of things. In the near term, the election will have no effects on our policy decisions.
Not going to talk about it, but then kind of talked about it a little bit. That conversation up next.
Bloomberg covers the world with unmatched reach and resources.
I think everyone, of the 8 billion people of Earth, I think everyone's going to want their Optimus buddy. And there's going to be maybe 2. And then they'll be producing products and services. I predict, actually, provided we address risks of digital superintelligence, 80% probability of good, a good outcome. Look on the bright side. The cup is 80% full. The cost of products and services will decline dramatically, and basically anyone will be able to have any products and services they want. It will be an age of abundance, the likes of which people have almost no one has envisioned. It'll be something special. So, now, one of the things we wanted to show tonight was that Optimus is not a canned video. It's not walled off. The Optimus robots will walk among you. Please be nice to the Optimus robots. So you'll be able to walk right up to them, and they'll serve drinks at the bar. And you'll directly, I mean, that's just, it's a wild experience just to have humanoid robots, and they're there, you're just in front of you. So, yeah, with that, let's party.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Would have been the time to say, we at the Fed have to look at deficit spending as generally inflationary. We at the Fed have to look at tariffs as potentially inflationary depending how much it gets passed on. And he could have said that in general terms first. Instead, now that he's here, of course, he can't say anything different than what he said. The big line for me, beyond what you mentioned before the break with Mohammed, was the saying that we don't have a plan, we don't have a commitment from here. So look for more of that. Look for more of them trying to undermine the market's bets of how much cuts there's going to be, but in a non-political way.
Adam, did you think that yesterday was the beginning of that? Was the opening of the door to some sort of pause next month that could really be the beginning of exactly delayed expectations, just pushing it out, pausing for longer as they wait to see what exactly will get put into place?
Yeah, Lisa, I think that's where we're at. I don't think necessarily it's going to be a pause next month. Obviously, I think they'll cut 25, and I don't think they'll fully announce a pause. But I think they'll try to slow it so that they maybe skip January, cut again in February. And by February, you'll know what executive orders the Trump administration has given. You'll know what the budget proposal looks like, in which case, by February, they could be warning that's it for now.
It seems like there's a narrative shift happening right now in markets where it used to be that maybe this Fed would front load cuts in the beginning of 2025. And now you're seeing an increasing number of forecasts saying the Fed will probably cut 25 basis points in December. And then next year will probably pause, certainly for the first half. They won't need to raise rates, but they won't necessarily be able to cut them much beyond 4.25% Why do you push back? Why do you see such potential still for rate hikes next year?
Well, Lisa, as Jonathan kindly indicated, and you've had me back, we've been talking about this for almost 6 months now. It's, in the end, what doesn't matter who's president, what matters is the policies. If you do large unfunded tax cuts, you tend to get inflation. If you do tariffs on a large scale and on broad, rather than just on a couple countries, you tend to get inflation. If you do things to indicate that maybe the current Fed chair isn't going to resign, and I'm sure he won't, but that the next Fed chair is going to be better terms with the president, that tends to raise inflation expectations. But the other thing is nothing to do with policy, it's economics. The Fed, I think, has overestimated how tight they are already and underestimated the strength of the U.S. economy. And so I think part of the market repricing prior to the election was based on the economics becoming clear.
Adam, when it comes to tariffs, there seems to be a debate on how much Donald Trump can do unilaterally versus what he needs congressional approval for. What do you make of that? I believe if you look at the law of Section 232, what Commerce is able to indicate to the executive branch, Donald Trump has a lot of leverage when it comes to tariffs on his own.
I completely agree with you, Anne-Marie. I mean, so Senator Rand Paul has put out a proposal to reassert congressional authority, and I think has a legitimate case to make that bill and say this is a tax, and taxes should be voted on by the Congress. But on the current law, there are all kinds of ways. You mentioned Section 232. There are various anti-dumping measures. There's national security measures, all of which Biden either kept in place or used himself, all of which the Congress didn't challenge under Trump or Biden. So unless Senator Paul's bill passes, which I doubt, I hope it does, there's no reason Trump can't just immediately put on tariffs first day. I mean, I'm sure he may not do it literally first day, but I'm sure he's got the executive orders drafted. And legally, politically, precedent, yes, he can do it.
Do you think he is going to use tariffs as a negotiating tactic, or do you think he is going to come out with full blanket 60% on China and 10% on the rest of the world?
I think he is more likely to come out with that than to, and then try to use it as a negotiating tactic. Look, if you're an honest macro forecaster, which I try to be, sometimes you want to be wrong. You want to be wrong either that you think they're going to do a certain policy, they don't do it, or that the policy has different, better effects than you think. So it is possible that Trump just threatens and waits to see what he gets from people, and he doesn't actually put up the tariffs. As I've argued, I don't think that's going to work because I think he has to be credible both to his domestic politics, but more importantly to his negotiating partners. But okay, maybe he won't. Maybe he'll get it all without threats. More interesting is the question, which some of the people speaking for the Trump campaign who will presumably be in the administration have said is, look, the tariffs can be removed or they can be escalated and the countries will cave, and when they cave, we'll get benefits. And again, that's where I hope I'm wrong. I don't think that's going to work, not so much because the countries won't cave, but once the tariffs are in, you're not going to get the results you want and you're not going to remove them. So, but I hope I'm wrong.
As we've seen with the current administration, who didn't remove hardly any of them. Adam, it's good to catch up, sir. It's good to see you. We appreciate your time, as always. Adam Posen at the Peterson Institute with a whole range of things to think about. I think the guiding light for a lot of us right now is just to wait for the cabinet positions. And that if you see the likes of a Scott Bessent in the Treasury position, who's been on this program and talked about using it as a negotiating tactic, I think it would give more weight to that argument, at least in the near term.
2.5% for 24 months. Xi Jinping tells when it starts to bite. Personnel is policy. That is why reading the tea leaves out of Mar-a-Lago is very important right now to the financial markets.
Coming up on the program, we'll catch up with Stephen Kirk of the Council on Foreign Relations as world leaders react to Donald Trump's win.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Three-day winning streak on the S&P 500, the longest winning streak going back to September. Just pulling back a touch this Friday morning. We're down by 0.1%. On the Nasdaq 100, we're down by around about a quarter. In the bond market, 2-year, 10-year, 30-year. 10-year yields actually down on the week. We're down another basis point this morning, 4.31. On a 2-year, 4.1870. Down a single basis point, with plenty of healthy debate around this table in the last 12 hours or so about the future of Fed policy and whether we could get a pause in December.
Either way, they clearly put inflation back on their bingo card, and CPI is going to be really interesting. When we take a look at the moves in the market this week, what stands out to me is what Mohamed El-Erian was talking about, that sucking sound of foreign capital into the United States. And yes, it will go into equities, but it will also go into bonds with a differential as wide as it is with the rest of the world. And that's what we saw with flows this week, as well as yields.
So the follow-up to Mohamed that we really need to get into next time is where the money is coming from. Where's it being sucked away from? At a time where the UK is going to issue more debt, when Germany is going to put bond supply on the ballot effectively. Where does that money come from? Do they have that fiscal space if they want to counter some of the policies that we're seeing take place in the United States?
What we saw from Germany is when there was the dismissal of the finance minister and the suggestion that maybe this opened the door to loosening the fiscal purse strings, a question mark about whether anyone would finance it, yields rose. And that you didn't see that knee-jerk response in the same kind of way in the United States. And it raises this question, do they have that much less room to do so because there is so much money flowing to the United States?
There is a belief that a Trump presidency is bullish for stocks, it is bearish for bonds, and it is bullish for the US dollar. The US dollar on the week so far, just about positive. We're looking at 6 consecutive weeks of gains potentially on the US dollar. 6 weeks of strength. The longest weekly streak going back to September 2023. Euro dollar, 107.69. Under surveillance this morning, full control of Congress, hanging in the balance. According to the AP, Republicans nearing a majority in the House with 211 to 199. 25 races have yet to be called. The GOP securing control of the Senate, 53 to 45, with 2 races yet to be called. That race for the House is the big one.
This is the big one because this will determine whether or not they have the trifecta. I go back to what Punchbowl has this morning, speaking to House Majority Whip Tom Emmer. I don't care if it's 218, 219, 220. I don't give a damn as long as we have the majority. But then Jake Sherman points out the fact that that means 0 room for error. Absences, illnesses. Do you want to take Representative Elise Stefanik from a New York district and maybe put her at the United Nations? How difficult will that be if you have no wiggle room and you don't want to run special elections? You want to hit the ground running when it comes to immigration and tax policy.
What did you make of Signum's take on this? That ultimately, you said, is everyone going to be a king? And he said, no, there's going to be one king and they're going to do everything top down and they'll just follow their leader. Do you see it the same way?
I think it's somewhere in the middle. I do think it's somewhere in the middle. I don't know if you're going to have 218 Joe Manchins walking around the lower chamber of the House of Representatives, but Donald Trump is going to feel like, I mean, rightly so, when you look at the direction of travel of the United States and how the votes came in, he's going to feel like he has a mandate. And he thinks that that's going to have to trickle down to individuals. We also know how he feels about people having, you know, personal loyalty to the head of the party. So I understand where Casey's coming from, Bob Casey there of Signum. At the same time, there's going to be certain districts, maybe they are in their Republican rep in a district that Kamala Harris won, and they're gonna need to push back a little bit.
To that point, French Hill's comments on the deficit were interesting to me yesterday. And there's a question of what mandate, especially if certain people try to impose some fiscal discipline.
Guardrails, do they come from the market or do they come from the lower chamber? We'll see. China, looking to boost its economy ahead of a second term for Donald Trump. Authorities announcing $1.4 trillion program to support local governments and refinance debt. The plan allowing local governments to issue more bonds and save on interest in the coming years. This is smaller than some people had hoped for. Is that fair to say?
I think that's fair to say. I also think there are people saying, are they going to provide direct stimulus to individuals, to consumers who can go out there to spend? Are they going to build another bridge to nowhere, albeit not necessary, but maybe that could help industrial growth? Are they going to necessarily support housing prices? You can refinance debt and save 600 trillion yuan on what we see with respect to interest payments. It underwhelmed expectations. And it raises the question, was this what they were hoping for? Do they have the capacity to stimulate on the levels that some people were hoping for, given that everyone said they were waiting to see whether Trump got back in the office? Well, they saw what happened, and this is what they came up with.
Right, but is the policy going to be, to Adam Posen's point, is it going to be blanket tariffs or is it going to be a negotiating tactic? Maybe that's why it underwhelms. They actually want to see what Trump does in the first 100 days.
Everyone's thinking the same thing. What about Nippon Steel? You're not thinking that, but let's talk about it.
I am.
Saying it expects to complete a $14.1 billion takeover of U.S. Steel by year-end. The deal continues to face opposition from unions and the outgoing Biden administration. President-elect Donald Trump repeatedly pledging to block the deal on the campaign trail. Where does that confidence come from?
I say I'm thinking about this because I spoke to a source about Nippon Steel last night. It's been hanging out in political purgatory in CFIUS. CFIUS has been used for, I think many would agree, blanket political reasons because of Pennsylvania and their 19 electoral votes. Now that the election is over, Biden is a lame duck president. It looks like it's going to be a Republican trifecta. He could potentially allow this through. My advice to Japanese leaders and the union would be to make a quick trip to Palm Beach and get the incoming president's approval as well for this deal if he wanted to go through. But it was hanging out in political purgatory, and those conversations are going to start as of last night.
I just want to pick up on what you said, that this was political purgatory. Now that the political purgatory is over, Joe Biden maybe not be as opposed to it as previously thought. Maybe CFIUS will realize it's not a public security concern, and that is what I'm actually very curious to see.
Did you notice the energy that Joe Biden has yesterday, President Biden? Just a little bit of a skip.
Pep and a
No?
step.
I saw all the memes. I saw them. I saw that they were saying now he's energy.
The media has got to call it as they see it. It's a mistake they've made for the last several years with this presidency.
He seemed cogent and energetic.
Thank
and happy.
you. Some energy. Where did it come from? I don't know.
I think President Biden might think, and this is just speculation, some conversations I've had, I think he thinks maybe he'd perform better, especially in places that Donald Trump won in Pennsylvania. At this moment, history will tell, he's the only individual who was able to beat Donald J. Trump.
What happened this summer, that weekend? Someone's still got to write the book, and I'm looking forward to reading it. What happened that weekend at the beach house in Delaware? Who pushed him to step down? Who wrote that letter?
Well, let's think about who President Biden has yet to speak to since he dropped out. I don't believe him and former Speaker Nancy Pelosi have yet to have a conversation.
It's a book to buy this Christmas, potentially. Or maybe not, maybe next Christmas. Let's turn to foreign policy. World leaders preparing for Donald Trump's second term. Israeli Prime Minister Benjamin Netanyahu reacting enthusiastically to Trump's re-election. Both Vladimir Putin and Volodymyr Zelensky congratulating Trump, but Putin giving no indication he's ready to make concessions to end the war in Ukraine. Joining us now is Stephen Kirk of the Council on Foreign Relations. Stephen, welcome to the program. Just first of all, let's start in the Middle East. What do you think changes with the election of Donald Trump?
Well, let me just say that the Middle East is the one region of the world right now where most leaders are very, very happy. I think with perhaps the exception of the Iranians, all of the leaders were quick to call Donald Trump and issue him the warmest congratulations for his overwhelming victory. I think what changes mostly is that, the head of the State Department transition, a guy named Brian Hook, said it yesterday, that almost assuredly the Trump administration would tighten sanctions on the Iranians. Maximum pressure is going to be back. The Biden administration has allowed the Iranians to sell a lot of oil on the market, to keep gas prices low for Americans in this election cycle. Donald Trump and his team are looking to put that pressure back on the Iranians. When it comes to the war in Gaza, the president-elect has been vocal in telling the Israeli prime minister that he should wrap things up by Inauguration Day. I'm not quite convinced that that's going to happen, but I think the difference here is that the Trump administration will allow the Israelis even more leeway to pursue military operations as they see fit to bring this conflict, this terrible conflict, to an end sooner rather than later. And that may include, I think it likely will include, releasing weapons that the Biden administration has held back from the Israelis.
Stephen, regardless of what happens with Israel, do you think that a Trump 2.0 is going to push almost immediately for an expansion of the Abraham Accords?
Well, since the Abraham Accords were President Trump's signature foreign policy achievement during his first term, I think it's likely that Trump will go back to the Saudis and say, let's talk about normalization. The Saudis remain interested in it. Their price has gone up as a result of the conflict in the Gaza Strip, but they see it as a strategic choice to normalize with Israel and integrate the region. The obstacles to this, of course, are if the Saudis continue to say that a two-state solution is a requirement, something they were not saying prior to October 7th. But nevertheless, this is going to be something that the Saudis and the United States are going to be involved in. And since President Trump has kind of a unique relationship with the Saudi leadership, he may very well get somewhere.
So, but as to your understanding right now, Israel, the war in Gaza would need to be settled, and then, I mean, in terms of the timeline, and then he can move for potentially opening up that kind of peace deal between Israel and Saudi Arabia.
There's lots of things that they can do short of normalization and short of the Saudi requirement, which was encouraged, by the way, by the Biden administration. But yes, I think they will negotiate this. They will push this. They may make some progress, but I'm not confident that we'll see a normalization agreement soon.
Expanding outside the Middle East, how quickly do you think Donald Trump will get on the phone with Vladimir Putin?
Oh, I think that this is something that's going to happen relatively quickly. I think the president ran in part on being able to settle these conflicts around the world. And his base does not like and the Republican Party does not like the support for Ukraine. And so I think the president, who sees himself as a master deal maker, is likely to get involved in this negotiation relatively quickly. This is obviously making Europeans very, very nervous. But nevertheless, this is going to be the policy of the United States, is to pull back from the support for Ukraine. And you can tell that this is going to be the policy because the Biden administration is scrambling to lock in a variety of ways of supporting Ukraine between now and Inauguration Day, I should say.
Stephen, do we have any sense of what that deal looks like between Russia and Ukraine that Donald Trump would like to orchestrate?
It's very unclear, but I think that we've seen some people in Trump world talk about a sort of stand in place, acknowledge the fact that the Russians control parts of Ukraine and negotiate from there. I think that there is a view that the Ukrainians are never going to regain that territory, and so therefore let's negotiate new lines. But it remains to be seen whether Vladimir Putin is emboldened by Donald Trump's election, and it's possible he won't agree to that.
There's a larger question, too, Stephen. You said that this is making Europeans very nervous, that Donald Trump is opposed to providing the same level of support from the United States for Ukraine. At the same time, you've seen European pushback as well among the public against some of the funding that officials have put into place. Is there a movement taking place on the ground that sort of also is pushing these two countries together?
Yeah, look, it strikes me that the effort in Ukraine is something that is important for NATO and NATO cohesion, and Donald Trump is skeptical of it. The American public is obviously skeptical of it. European publics are increasingly skeptical of support for Ukraine, but the Europeans, of course, have a lot more to lose than Americans. There's going to be a tremendous pressure on European governments to do something about Putin. The eastern flank of NATO is, in fact, exposed if the United States ratchets back or ends its support for Ukraine. I'll point out that Donald Trump has said that he would pull the United States out of NATO. So, of course, that's something that you might say during an election campaign or not. It may or may not be policy, but there are likely to be changes happening in Europe, and those are going to have political reverberations in Europe as well.
Stephen, it is worth noting the new leadership at NATO. The Secretary General, Mark Rutte, the former Dutch Prime Minister, has been on the program with us and said live on TV that the former president, now president-elect, was right about what he said about NATO. Do you have any fears about a relationship being soured there? Because at the moment, on the surface, it looks like there could actually be a pretty decent one.
Yeah, you know, look, President Trump takes a tremendous amount of criticism for his relationship with Europe during his first term, but he did spur NATO allies to spend more on their defense. NATO has ramped up its spending and its defense production, so that is an overall good thing. The question is what President Trump is likely to do early in his term. Is he going to follow through on the promise that he would take the United States out of NATO on day one? What is the policy? And we really don't know. And I think in your previous segment, you talked about who's showing up at Mar-a-Lago, who's doing what is a telltale sign of this. One heartening thing on this issue is that the person who's running the State Department transition is not someone who's likely to recommend the United States leave NATO. But of course, the only policymaker really here is President Trump.
Stephen Cook, appreciate your time, sir. As always, Stephen Cook there of the Council on Foreign Relations. With an update on news elsewhere with your Bloomberg Brief, is Danny Berger.
Hey, John, Rivian shares are basically unchanged, slightly lower. It said that it was on track to achieve a gross profit in the last 3 months of the year. The EV maker is counting on a surge of regulatory credit sales after production disruptions added to losses. Despite maintaining its forecast, Rivian's third quarter earnings missed Wall Street expectations. Now, Paramount Global reported big gains in streaming subscribers in the third quarter, shares up 2% pre-market. Overall sales, though, at the parent of CBS, MTV, and its namesake Hollywood Movie Studio were weaker than expected due to declines in TV and film revenue. Paramount is working to close its merger with Skydance Media in the first half of 2025. The deal would see producer David Ellison take over the company. Richemont shares, those are plunging 4.1% in the European trade. The Cartier owner reported a profit slump in the first half of the year. Its watchmaking division faced falling demand in China. Sales were stable, but operating profit booked a 12% drop. Other luxury brands like LVMH and Kering have also felt the pressure from weak consumer demand in China. And that's your brief, John.
Danny, thank you. Up next on the program, Fed independence.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
No. That conversation up next. Not that one, because that's not very long. A much longer one.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I think we're ready? Go.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from New York City, welcome to the program. Under surveillance this morning, Fed independence.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe that the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
So here's the latest this morning. Fed Chair Jay Powell dismissing the idea of stepping down if Donald Trump asked. The president-elect has a history of publicly criticizing the Fed chair and recently called it the easiest job in Washington.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god.
Let's talk to one of those gods, the former Kansas City Fed President, Esther George. Esther, welcome to the program. It's so wonderful to hear from you once again. How difficult is life about to get at the Federal Reserve?
Well, it's never an easy path when you get to a time like this. But remember, Jonathan, this institution was by design anticipating that there would be political influences on it. And so a lot of safeguards were put around it to allow the individuals that sit around that table to really maintain their focus on the American public and the mandate that was given to it by Congress.
There is a confusion, though, Esther, given the fact that a lot of the potential proposals would have a fundamental effect on the trajectory of the economy, and that's certainly what the market seemed to be responding to. Do you think, if you were on the Fed, you'd be rethinking just how much further the Fed can cut?
Well, there's no question, Lisa, that you have to take into account fiscal policies and the impact they can have on the economy. And of course, when you're making a forecast, you have to be thinking about what are the risks around that forecast. Whatever baseline you set, you have to be thinking about what lies ahead in terms of setting a path. And I thought yesterday, the chairman was pretty clear that he wasn't going to offer any forward guidance about what comes next. And I think that's really the right way to handle it at this stage.
At this stage, December isn't going to be so easy because they do have to release a new statement of economic projections. I'm sure that you are very glad that you don't have to offer up yours. How do they signal a potential scenario analysis around something that the market is actively considering and responding to?
So I think where we will see that, certainly you could see it play out in the median assessment of those 19 forecasts, but you'll also see it in the statement where this committee will talk about the balance of risk, and they will talk about their own assessment of what the path ahead might look like. Today, they're relying on what they know, which is we have the economy that's handed to us. We are saying risks are roughly in balance. You heard the chairman say several times what the trade-offs are between going too fast versus too slow. And so it will be a while before they get any clarity on what steps will be taken in Congress, in the administration, that will begin to bend the curve of those forecasts.
Esther, can we rewind and play the tape back? Because you've lived this. You lived the tax cuts in 17, and you lived the trade war in 18. And we're asking the same questions of people now that we were asking at the back end of 16 when President Trump was elected to his first term. Could you share with our audience your experience in at that time, how long things took to really start to consider what was happening on the other side of Washington?
So there's the real challenge for the committee when you are watching how fiscal policy might play out. So you can see today, for example, if you're thinking about tax cuts as we were back in 2017, at what point do those feed through the economy? When do you feel their full impact? And importantly, what else is going on that is going to counter whatever you might estimate those effects to be? So it is really a process, as it was when I was at the table, of saying, what are the various scenarios? Where might we see more immediate impact? And then what tends to play out over a longer time frame? Also taking into account other things going on in this very large and complex economy that we're trying to make an assessment of.
Esther, that final point I think is the more important one. The tariffs back in 18 didn't turn out to be as inflationary as some people warned. Is there reason to believe that given the backdrop now, given the current context for things, that it could be more inflationary this time around?
Well, I think by the Fed's own admission, there are upside risks to inflation right now. Inflation has not returned to target, even as it has come down. We are looking at a fiscal situation that is likely to bring upside risk here. We're looking at really global trade and changes and shifts there. So many aspects of what we see playing out today, I think, give good reason to be cautious, to think about those upside risks, even as you watch any given action taken that could be pro-inflationary.
Esther George, thank you for sharing your experience with us this morning. We appreciate it, as always. The former Kansas City Fed president there, Esther George, on the introduction of two-way risk in 2025 in a more material way in the last few days.
And her point that this is a different circumstance. You have to look at the economy that you have. And one thing that Adam Posen said that he thinks that this Fed has been missing is that the economy actually had more inflationary momentum heading into this period of time than they currently have been talking about.
Similar to the view of Torsten Slok of Apollo.
Correct.
I just wonder how quickly before we're talking about rate hikes in 2025. Got to see what the policy is, got to see what the margins are, see if we even get a trifecta first. Let's get through the week. It's a lot to figure out. Up next, Jim Bianco of Bianco Research, Ryan Peterson of Flexport, Mark Giannoni of Barclays, and Subhadra Rajappa of SocGen.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
For more our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it, on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of a technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like this redefine a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point.
They're kind of on an autopilot to get rates down to around 4% in the early part of next year, and then we take it from there.
You've got to preserve the economy in some sort of steady state. We're too high right now.
As you get into next year, listen, I mean, you got what could be a pretty significant policy changes. I think Jay Powell will want to preserve optionality for 2025. A lot can happen.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Can we fast forward to Thanksgiving? Don't you just want to skip the next few weeks?
You just want to skip the
holidays.
break. Yeah, because I have a day off. That's exactly what you're saying.
You know what's happening at my house soon?
What's
might happen this weekend.
Oh, the Christmas tree? Oh,
no,
my
that
goodness.
might happen. Getting closer.
Come on. It is not closer. It's not even November 10th.
Mid-November this weekend.
Bloomingdale's is already playing the Christmas music.
Trees ready to go.
Yeah, you're really getting in the spirit.
Decorations ready to go.
Love it.
I'm in the spirit. Stocks are at record highs. Trees going up, lights are coming on, music's going to start playing. Equity futures down by just 0.05%. On the Nasdaq 100, we're down by 0.2%. In the bond market, 2-year, 10-year, 30-year, 10s at about 430, way off the highs of this week. We got very close to 450, and then Lisa backed away.
A real question here about how much is some sort of overplaying of expectations and how much is real. I think that this really put it well, this what economists saying. There's a sense that even the most exuberant Trump trade investors are taking a step back to think, at this point, are the bets overdone? I think the conclusion in equity markets is, probably not. That's what we're hearing. In bond markets, people are saying, just hold on a second. Let's see exactly what these policies are.
Let's see exactly what the makeup of the House of Representatives is. It might be 218 to 217. It looks like they're on course. They are poised for this trifecta, but they're not going to have a ton of wiggle room. Absentees, people not being there, this could become very challenging. And then, of course, you have to think, what do they actually want to fight about? What do they want to get through first? Is it going to be immigration, which it feels like a lot of individuals, when you look at exit polls, went out and voted on that? Or is it going to be tax policy? And the former president basically threw every potential tax cut at the wall. Which ones actually stick?
Two very different scenarios. They might fall short. I mean, the great assumption right now is that they won't. I think there is high conviction that they will get a majority in the House, a very small margin, but we're not there yet.
It seems like when you talk to stock investors, they're saying even if there isn't some big mandate, just the extension of the tax cuts, the lack of this sort of risk, this event risk hanging over the landscape. And given the incredible earnings that we've gotten, earning beats across the board, people are able to bet on that again and less necessarily on the uncertainty. And this has less to do with some of the proposals that could come down the pike.
I will say, I think one risk was taken off the table last night, and that was Susie Wiles, respected inside, outside Trump campaign. She is going to be a human moat, is what I'm going to call her, around the future President-elect Donald J. Trump, because she's going to make sure voices that really are not in line with the agenda that she was running from behind, the backbone of that campaign, they are not going to be in the West Wing.
We are all looking for policy signals. And within the tea leaves, I think the guiding light right now is to look for the cabinet positions as that starts to come together through the next few months. So one to watch. Coming up this hour, we'll catch up with Jim Bianco of Bianco Research on a Fed policy mistake, Ryan Pedersen of Flexport on the impacts of Trump's trade policy, and Mark Giannoni of Barclays on why a December rate cut is not guaranteed. We begin this hour with equities near all-time highs following Trump's election win and Chair Powell's latest rate cut. Jim Bianco of Bianco Research saying, I'm a no-lander. The Bloomberg Surprise Index is at its highest level since February. Now we have fiscal stimulus in the form of tax cuts and deregulation. The Fed is overstimulating and setting up inflation problems in 2025. Cutting rates now, wait for this, cutting rates now might be worse than transitory. Jim joins us now for more. Jim Bianco, that's some punchy stuff right there. Let's build on it. Are you talking rate hikes in 25?
You know, I don't know yet if we're going to need rate hikes. It depends on how many more rate cuts we're going to have. If you look at the market is pricing in about 3 more rate cuts. Well, if we get one in December, because it's got a better than 50% chance, I don't know if everybody's ready for the idea that by the end of the year, this whole rate cutting campaign will be mostly done, if not completely done. If the Fed does want to follow through on the Austin-Goolsbee line, that they have hundreds of basis points to go to get to neutral, then they might overdo it and we'll need rate hikes in 2025.
Jim, considering we're also talking about the potential for a positive growth shock, is that a world in which stocks continue to do well?
Yeah, well, there's only really one thing that's going to stop stocks from going up, and that is the prospects of inflation, overstimulating and creating inflation. Look, if we have no inflation, and if inflation is defeated, as a lot of people say, then why didn't the Fed cut rates to 0 yesterday? What's to stop them from becoming massively stimulative? The idea is that if you create inflation. And the only thing that stops you once you get inflation is the bond market. Yields will go up so much, it will then stop the rally. And so, you know, that's what I think is going to have to be the big fear in 25. Because right now, with all the stimulus we're talking about, both fiscal and monetary stimulus and deregulation, there's nothing to really stop this market unless we get inflation and we get high interest rates.
Jim, yesterday the message from markets seemed to be that just even the prospect of the Federal Reserve not cutting by 25 basis points next month would be enough to tame inflation, sufficient to really ignite that rally in the long end of the yield curve. Do you think that bond markets are getting it wrong?
I don't think they're getting it wrong. I think what it is that we're talking on, election and Fed week. We're talking about a week where the MOVE index, which is like the VIX of the bond market, had a 13-month high at the beginning of the week. We were coming into the week with all of these volatility measures saying that an average day is about a 15 basis point move in the 10-year yield, which is enormous. So we're kind of overreading a lot of the volatility that we've been getting this week with whether or not the trends have been changing. But if you step back and you look at the bigger picture, the uptrend in yields that started with the Fed cut in mid-September, I think is very much intact.
What are you looking for to understand truly the amount of inflation that could be in the system currently, as we heard from Adam Posen, as well as what could really get ignited with the extension of tax cuts and potentially other stimulative measures?
Well, I think, as far as inflation, let's remember what 75% of the average basket is. It's in services. And that's why, I'll come back to Powell's, super core measure of services less housing core less housing services as actually being a fairly good measure, because what it's trying to measure is wage inflation, and it's over 4%. And if we continue to see that kind of measure of wage inflation, I think you're going to start to see inflation move up. Yes, you throw in the potential of tariffs. Tariffs are another form of inflation because they increase import prices. And then you've got the stage set that you could see the inflation rate, which, by the way, seems to have been, I'll use CPI, or core CPI, excuse me, bottoming around 3% right now. It stopped going down. And then if it does really start doing that and start going up, you could start looking at this idea that we're not in a 2% world, we're in a 3% world, and that should be unacceptable for the Federal Reserve, and they should not be cutting in that type of environment.
Jim, do you think the immediate inflationary impulse will come from tariffs or tax cuts?
Oh, I think it'll probably come from tax cuts, the making permanent the corporate tax rate, and I think it'll also come from some moves on deregulation. Tariffs is a difficult one. I mean, everybody asks me about it, and they're about 50-50. 50% of the people that I talk to about it think tariffs are going to happen, and the other 50% think it's a gambit just to get a deal in place threatening tariffs. And so whether or not we get them is still an open question. I happen to be more in the gambit side of it, that he's threatening tariffs to get some kind of a deal and that we actually won't see as many.
Do you think the market is over their skis, though, given the fact that we don't know what the margin is going to be in the House of Representatives?
Yeah, it could very well be. I mean, there is an assumption that the stimulus that we're going to get, the fiscal stimulus from the Trump campaign or from the Trump administration, is going to not see many roadblocks. And one big roadblock, especially when it comes to tax policy, could be whether or not we get any kind of a red wave that extends to the House, and extends the House by more than like one seat, because one seat can always, throw any kind of legislation into order. So maybe it's getting a little over its skis right now, but, it's really hard to argue with the market the way it's been rallying.
Jim, we've been playing a game throughout the week with every cross-asset strategist, which is how high do bond yields have to go before equity investors care? And we've gotten a range of different answers. Some people say 4.5%. Other people say that's a silly question because it really depends on the circumstance that we're looking at. Do you have a sense of what would make this equity market really watch the bond vigilantes much more closely? Do you have a sense of what it would take at a time where it seems like stock traders are unfazed by everything?
Yes, and you're not going to like my answer because it's 425 and we're already above it and we're already at that level. Now wait a minute, the stock market's at a new all-time high.
Correct.
Again, that comes back to what you're seeing in this market is the emotional reaction of the election and the unleashing of potential fiscal stimulus. So it doesn't matter if bond yields were 525 this week, the stock market was going to go up. But I think once we get past this period, we're going to start to see that these yields right here at this level, and if they continue to move higher, is going to be a headwind for the stock market. Why do I say that? Because go back before Monday. What was the stock market doing in the 3 weeks going into Monday? It was struggling. And why was it struggling? Because yields were above 425. And so I think we're there right now. We're just kind of sidetracked with the euphoria of massive fiscal stimulus coming. And once that wears off, if these yields stay at these levels or go higher, it's going to be problematic.
This is a really interesting point, especially if you look at the areas that have outperformed in the equity markets, which is small caps. And traditionally, small caps are more leveraged to yields that are higher. They tend to do worse. Are you expecting that trade to be a head fake and essentially for the yield space to really reassert itself over smaller, more leveraged companies?
I think over time it will. I think what you're seeing in small caps is that's another way of saying value stocks, because everybody's been running towards value in this last couple of days with the idea that fiscal stimulus just means earnings. It means people are going to show up at your store and buy your products or your services. And that's what's got everybody kind of rushing towards those kind of companies. And so I do think, yes, once we get past this euphoria, it might be somewhat analogous to what we saw in China last month when they started all the fiscal stimulus and their stock market rocketed higher for 2 weeks. And then that was it. And it's really been kind of meandering sideways to maybe slightly lower. So yeah, we're in the rocketing part for our stock market right now. It might not be done with, but then we'll go into that phase with, okay, we priced it all in, and now we're going to have to sit there and wait to see if any of this stimulus materializes. And then in the meantime, if interest rates are staying at these levels or going higher, it'll start to weigh on it.
Jim, you're one of the best, always thought-provoking. It's good to hear from you. The super thoughtful Jim Bianco there of Bianco Research. Andrew Honhorst of Citi just publishes, rate cuts are still coming. We continue to think markets are underestimating the softening of the labour market as well as the dovishness of the Fed's reaction function. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President-elect Donald Trump has picked his chief of staff. Susie Wiles, one of the top architects of his presidential campaign, will take on the key role in his second administration. Trump says that she helped him achieve one of the greatest political victories in American history, and she will be the first female White House chief of staff. San Francisco is set to elect Levi Strauss heir Daniel Lurie as the city's next mayor. Lurie won the election with around 56% of the vote, with the incumbent, London Breed, conceding the race. His election is seen as a sign of the residents' dissatisfaction with the status quo in San Francisco. Lurie, who spent $8 million of his own money to fund his campaign, has vowed to tackle issues like homelessness, crime, and corruption. The Baltimore Ravens beat the Cincinnati Bengals in a thrilling comeback win on Thursday Night Football. After trailing 21-7 at the half, Ravens QB Lamar Jackson led a furious comeback with 2 huge touchdowns, both over 65 yards long, and he stayed hot in the fourth quarter to put the Ravens up by 7. The Bengals managed to storm back for a touchdown in the final minute, but they decided to go for 2 instead of playing for overtime and missed the 2-point conversion. That's your brief. John.
Danny, thanks for the update. You'll hear from Danny again in about 30 minutes. Up next, the morning calls, plus Ryan Peterson of Flexport on the outlook for Trump trade policy. That conversation just around the corner.
Politics to the world of business. Joe Matthew and Keely Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Equity futures right now negative by 0.07%. Yields a little bit lower, down 2 basis points. The 10-year 430.62. Time now for some morning calls. First up, Telsey upgrading Home Depot to outperform, expecting Fed rate cuts to boost shares. That stock is up by 0.9. Next up, Barclays raising its price target on Expedia to 153, citing better than expected third quarter bookings despite a drag from inclement weather. The stock is up by 3.4%. And finally, Citi upgrading Bank of America to buy, saying it could benefit from lighter regulation under the new Trump administration. That stock is up by another 1% in the pre-market. It's already higher this week by 7 percentage points. Turning to trade, President-elect Donald Trump proposing 60% tariffs on products from China and between 10 and 20% on all foreign goods, resulting in more questions than answers about how his administration will implement them and how fast. Joining us now is Ryan Peterson of Flexport. Ryan, welcome to the program, sir. Let's start with this. How busy are you right now? And has business increased a ton over the last few weeks?
Yeah, well, not just necessarily because of the possibility of a Trump election, but we also have a looming port strike on the East Coast. Remember, they went on strike last month, but they got a 90-day hiatus, and January 15th, that contract ends. So all the East Coast ports
right before Trump gets elected, may go back on strike. And so a lot of people are trying to get goods in before that might happen. So there's always something in global trade.
Joe Biden was called Union Joe. How do you think the port negotiations will go under President-elect Trump?
Yeah, it's a really big question. It's sort of like who he listens to, because he himself says back in October made statements in favor of the union and saying, hey, they need the right to negotiate against these foreign companies. At the same time, his main advisor now, Elon Musk, has said, well, that the union's demands for no automation are ridiculous and need to be stopped. So it's a really big open question. Who's Trump going to listen to, and how does that play out?
Because of that dynamic, do you think these talks could really drag on, and how long could we see them dragging into 2025?
Well, that's one big concern. Is sort of the talks are happening 5 days before the inauguration, and so what's the current Biden administration's role, and how committed are they to making that happen? And then that's, of course, with the backdrop of tariffs, which you were also alluding to here in your intro.
Potential strike. Can you give us some sense, some scope of just how much busier it is, how much rates are able to go up for you as people do try to get ahead of that uncertainty?
Yeah, I mean, you're seeing volumes they're a little bit higher, but it's very hard to attribute to any one thing in this. It's a very complex, dynamic world. So I wouldn't want to say, oh, the volumes are up this much because of tariffs or because of looming changes in policy. So I don't have a specific number to tie to it. That said, we've seen it every time. Whenever there's new tariffs, you see a big surge. You saw it with the Biden administration earlier this year when they increased Section 301 tariffs on Chinese steel, for example. That led to a big push, and ocean freight rates went up about 3x earlier this year. From long-run historical average, it costs about $2,000 to ship a container from Asia to the U.S. That went up to over $7,000 in the spot market this summer, and it was driven by that. It was driven by people pulling goods in both before the port strike and before the tariff. So we've seen this movie before, and we're probably heading right back into something similar.
I'd like to lead into this idea that we've seen this movie before. We've had the experience of the 2018 different tariffs that came to play, 2017, 2018. There's a real question about how much companies have already rejiggered their supply chains to adjust to a new reality, new pressures, a new focus on nearshoring and onshoring. How much have you seen a real shift in the patterns of your clients in terms of where they ship from?
No, it's been massive over the last decade, and not just driven by the tariffs, although that's a big factor, but also driven by labor costs. Chinese labor costs have gone up. It's good for the workers in China. They're getting paid more, but they're no longer the low-cost source of labor for the world. And so companies have been relocating. Companies that can have been relocating, especially Vietnam, India, Mexico have been sort of like three big winners, but many other countries too. And that said, there are a lot of supply chains where you just can't get it done outside of China. The manufacturing expertise, the ecosystem of component suppliers. And for that, I'm specifically talking about electronics. There are a few other sectors, but really the electronic sector has a real hard time moving manufacturing out of China. And then the other big factor, the other big industry here is e-commerce. Chinese e-commerce parcels, so going direct to consumer all the way from China, are close to 50% of the world's air freight now. And that is already being discussed to shut that down or to impose tariffs on it. Remember, those fly duty-free under the current regulations. And even the Biden administration has, and the current CBP has a directive, Customs and Border Protection, has a directive to take away those tariff exemptions. That may make those non-competitive. So there's a lot of different factors here. And I think you'll see an escalation because remember, these new tariffs are on top of the ones that the Trump and Biden administration put in. They're not, it's not just we're back to Trump's tariffs. Biden never took them away, and they'll be talking about adding on to those.
You mentioned Vietnam and you mentioned Mexico, and I just wonder, especially given some of the threats that we've heard from the Trump campaign, how much you see from the flows that Mexico is kind of a Trojan horse for Chinese goods, and the same with Vietnam.
Yeah, in both cases, you've seen exports from China to these countries increase by 20% over the last 2 years. And so that implies we're either moving goods there as raw materials into a manufacturing process, or in some cases, there's probably some fraud where they're just relabeling things and saying made in Mexico when it's actually made in China. I think it's probably much more of the former, much more of raw materials moving in. And so it's not necessarily, the market finds a way. You know, it's very hard to, when a country like China is so good at manufacturing, very hard for businesses to avoid using that. They're just going to have a competitive advantage, and the markets route around it. And the other factor here is that it's expensive. Trucking is expensive. So moving a container or a truckload of cargo from Mexico up to the United States is not cheaper than shipping a container from Vietnam to the United States. Ocean freight, the physics are unmatched. It's so much cheaper than land freight. So it's not necessarily that just because Mexico's closer in terms of distance that it's cheaper.
There's one sailing route I wanted to ask you about, given we are going to have a change of an administration come January. The Red Sea, do you think we're going to see more freight go through there?
We've already started to see a little bit of restoring of services through the Red Sea just in the last month, and that's before Trump, you know, even anyone had an idea that Trump would win. Some carriers are starting to brave that. I think there's a real possibility for a breakthrough, but I don't have any insight into, you know, what Trump might do with Iran or the Houthi rebels there. But I think you should expect a new set of initiatives, policies, and potentially military action. But very, very unclear. One interesting story I thought didn't get enough attention was that this allegation that the Houthis, the rebels in Yemen, or really the government in Yemen, has been taking bribes effectively and running a toll road to the tune of $2 billion a year from ocean carriers and ocean shippers to move cargo through as sort of a payoff to not shoot missiles at them. That's a really crazy development if true, and I'd like to see more about it. I don't have any sources on that other than reading it in the news.
Well, I know a reporter around this table that's going to chase that story a little bit more now, Ryan. Appreciate that. Ryan, let's do this again soon. This was super sharp. Really appreciate your time. Ryan Peterson there of Flexport. I want to talk about Mexico. The Deputy Trade Minister of Mexico came out in the last month or so. 70% of Mexico's imports from Asia come from about 50 foreign companies. A large chunk of those 50 foreign companies, American. And a large chunk of those American companies, auto parts, automakers. This is a big, big issue for America, and the president-elect wants to get on top of it.
Yeah, although it's so unclear where things are made and how much maybe goods from China or goods from the U.S. are just getting shuffled through 15 other countries to kind of, I don't know, not necessarily have an obvious origin.
I can't believe this stuff is still happening in the Red Sea. Still haven't cleared it up.
It's still happening, and actually it is adding to baseline inflation for a lot of these companies.
Up next, a look ahead to next week and a ton of economic data.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Check out the markets, totally unchanged on the S&P 500. You can take a little bit of a breather this morning, at least so far. On the Nasdaq 100, we're down by 0.2%, coming into Friday at record highs. With 60 minutes until the opening bell, with your morning movers, here's Manus Cranny.
Jonathan, spoiler alert, 2 billion people have checked into an Airbnb in the lifetime of this company's existence. I helped them in the third quarter, but obviously not enough. Bookings were up 8%. So the issue is this. How are your margins? You're having to spend so much more on getting me through to the final click. That is what is weighing on this. The investments weighing on the margin. JP Morgan say it's about growth sustainability. Can it remain? If you look at the United States of America, okay, Marriott had a problem over the election, but the essence of it is we have a strong consumer here. Barclays says there's something for the Bears and the Bulls. They raised the price target to $110. They won't be put off. Now, Trade Desk, how do you synthesize TV advertising and online? Connect it up. That's the synthesis that you're looking for. Why is this stock down 10%? Bloomberg have put out their note. They think that there is a slowdown at hand to come, even though revenue grew by 27%. So a spoiler alert from Bloomberg Intelligence. How do you understand what's going on in China? $1.4 trillion worth of money has been made available to refinance the local debt. The reason why I picked Alibaba is what has been done to shore up the realm, defense of the realm of the consumer in China. On the macro side, we talk about the deflationary pushback or blowback into the United States of America from China. But here we are, consumer stocks. How do you defend yourself? You don't know what the tariffs are going to be. You don't know what the politics are going to be. And right now, the stimulus doesn't look as if it's on your side as a consumer. Jonathan, good morning.
Manus Cranny, good morning to you, sir. Appreciate it. And thanks for bringing up that stock. Just a bit softer in early trading. Lisa, I think it's interesting, the excuse that we hear, and we talked about this earlier this morning, that China's trying to save this ammunition for 2025 because they don't know what the policy is going to look like. Don't you want to get ahead of that? We talk all about this lags and all this stuff when it comes to policy. Don't you want to get ahead of that and do something about your domestic economy and make sure that it does have that resiliency to have things thrown at it?
So not to be a little cynical, but people have been making excuses for why we haven't gotten stimulus earlier. And they keep making excuses. And then they say, well, you actually see the effects of what's been put into place. And you have to start asking a question. Do they have the capacity and the willingness to actually put into effect the type of stimulus people are looking for, which stimulates consumer demand? That is really the key question. And honestly, an increasing number of people are saying maybe they just don't have the will or even the capability.
Yeah, you say excuses. It's actually just been one excuse, just the same one. On repeat, they're waiting. And then Donald Trump won. But they're still waiting. They're waiting to see what the policy is.
Exactly.
Then they're waiting. We're still waiting. We're waiting for 2025 and Fed policy and what it might look like. This is the view from Mark Giannoni of Barclays. We expect the FOMC to cut rates 25 basis points in December. However, in light of upward revisions to our inflation projections, we are changing our rate call for 2025. We now think the FOMC will cut rates only twice, by 25 basis points in March and in June. Mark joins us for more. Mark, good morning.
Good morning, John.
Let's start with that inflation projection. Upward revisions to our inflation projections. On what?
Well, what we learned this week is, with the results of the election, is that we will likely have an increase in tariffs next year. and we will likely have restrictions on immigration. And this is regardless of the outcome in the House of Representatives. So we think that with the tariffs, we are likely going to see an increase in prices, in the price level, that will increase inflation. We think already in 2025, we estimate that the tariffs could increase inflation by a good 0.5 percentage point next year. And then that might have some lingering effect in 2026. On top of that, restriction in immigration are going to, in our view, contribute to a tighter labor market. And with a tighter labor market, we are likely going to see a little bit more wage pressures by the end of next year. So all of that has contributed to raising our inflation forecast by about 0.4% next year and a little more in 2020.
So 2 points, tariffs and immigration.
Correct.
What are your working assumptions of what the tariffs will be, one, and what kind of immigration policies you expect to see?
So President-elect Trump has talked about imposing tariffs like 10% across the board, maybe 60% on China. We didn't take this full on board because we think that there's likely going to be some negotiation between the US administration and other countries. So we basically took half of that effect, roughly. And so we think there's a lot of uncertainty around the magnitude of these tariffs. But in any case, this is what we started with as an operating assumption. And then with that, we think that that would contribute to roughly half of the effect that we would expect under the full 10%, 60% on China tariff imposition. So with this, we expect that that would contribute to roughly 0.5 percentage point on the price level, which would translate to about 0.4% next year's inflation, about 0.1, 0.2% in 2026 inflation. And then on the immigration part, we think that President-elect Trump would impose tighter restriction that the Biden administration has already imposed with the executive action starting in June. We think that that would lower the flow of immigration further. The assumptions that we make here is that we would return to something close to the flows of immigration we've seen under Trump 1, basically in 2017, 2018.
So going back to tariffs, is the big charge from tariffs the cost that gets implemented either on the producer or the consumer, or is it that it has to be made somewhere else, and that somewhere else has to be the United States at a time where you've got a tight labor market, reduced flow of immigration, and maybe not even the expertise in certain types of production?
Right. No, exactly. So it's all of the above. So there's a direct effect from increasing the price of imports. And then there's a little bit of an offset for an appreciation of the US dollar, potentially, that could undo some of these. But then, to your point, then you need to produce the goods domestically. And so you need resources to produce these goods domestically. So that would raise the price on other goods and services domestically as well. I mean, there are a lot of effects going back and forth, but the primary effect is basically the higher import prices, and then maybe some more demand internally that would raise all of them.
Mark, if they're going to be made in America, though, the former president, future president, is talking about a 15% corporate tax rate. Correct. Can that help bleed into potentially offsetting the increase you would see from tariff proposals, maybe decreasing the price of goods?
So I think longer term, potentially. But I think in the short run, you need to produce the production capacity and construct the plants and all that in order to have a bigger production capacity. And you need the workers to produce all of that output that's now required to be produced in the US. And if you put tariffs at the same time as you limit immigration flows, it's not clear where the workers are coming from. If we had a 10% unemployment rate at this point, I would say there's a lot of slack in the labor market. You can, of course, absorb a lot of the workers to produce that. But with an unemployment rate at close to 4%, basically with the labor market at full employment, and a population that's aging, and all the workers basically not really returning to the labor market, it's not clear at all who is going to be producing that increased output.
So this week you changed your forecast. This week we didn't get new Fed forecasts. They were asked about their old forecasts, and Chairman Powell ummed and ahed. We get some new forecasts in December.
Correct.
How stale will those forecasts be in December? Because they're not going to take account for any of this until when?
Yeah, so Chairman Powell was asked a lot of these questions yesterday, and he said, basically, we're in the middle of that cycle here. And so it sounds like, so far, even absent any of the Trump policies put in place next year, even absent all of these news, we've already seen very resilient labor market in September. We've seen upward revision to the GDP, national income accounts. We've seen firmer than expected inflation prints. All of that would suggest that basically the unemployment rate, if anything, is going to end up the year lower than the Fed had expected back in September, that activity is going to be slightly stronger, that inflation is going to be slightly more elevated. This is absent any of the new policies that might come in next year. On top of that, I think for next year, we can anticipate, as I argued in our forecast, like higher inflation and more activity and potentially a tighter labor market. So I think that implies that the rate path overall is going to be, will have to be slightly higher than what the Fed had penciled in.
So I wonder, especially since Jay Powell was talking about inflation as a new concern that they're putting on par with employment, I'm wondering how high the bar is for next week's CPI report to potentially torpedo the chance of a December rate cut.
I think basically the FOMC meeting yesterday with the statement and the press conference have basically left all the options open at the December meeting. Our baseline is still for the Fed to go with a 25 basis point cut because and Chair Powell repeated yesterday that they see policy as being still restrictive. They think they want to go to a closer and more neutral level of interest rate. And so we think that they really want to cut rates. But I think it's going to be a close call. And in particular, if the inflation print next week come in firmer than expected, we expect something around 0.3% for core CPI next week. That's going to be higher than what they had, presumably what they had anticipated at the September meeting. And then we'll have another CPI just before the December meeting. And we'll have also an important payroll report in November, in the November payroll report in early December. That one is going to be particularly important because it's going to tell us something about the underlying pace of job gains. Remember that the last month's print was particularly noisy due to the hurricanes and all that. We expect like a very big rebound in the payroll print.
What's a big rebound, just quickly? What kind of number?
Well, we think the underlying pace of job gains is around 150,000 a month. With the 10,000 job gains in October, we think we could have easily a print of like 250, 300 in early December, if indeed this underlying pace is around 150. So the picture of the economy when you sit down at the FOMC meeting in mid-December is going to be very different than the one that they've anticipated.
I've got to say, that doesn't sound like a rate cut in December.
That's what I was going to say.
That sounds like a pause, Mark. It's good to see you. It's good to catch up. Appreciate your new forecast. It's good to look through. Mark Giannoni there of Barclays. Looking ahead to CPI next Wednesday as well. They're looking for 0.3 on core, 0.3 on core. Equity futures right now on the S&P 500 just a little bit softer. We're down 0.1%. The opening bell is about 49 minutes away. We're looking at equity futures declining on the Nasdaq 100, but you have to bear in mind we came into Friday at record highs on the S&P, at record highs on the Nasdaq, and we're looking at a weekly gain that is the best weekly gain of the year so far. In fact, we had the best post-election day of gains ever in the history of markets, and we had the best Fed day of gains ever as well. Is that right?
That is, and what you're looking at is the flows back that up. I thought it was just really fascinating. $20 billion flowed into U.S. equity funds on Wednesday, the day after Donald Trump was presumed to be president-elect. So this, to me, really highlights just how much people are putting their money into some of these moves that we have seen in markets.
Truly historic. Subhadra Jayapura, SocGen, with us around a table. She jumps into the seat. Subhadra, good morning. It's good to see you.
Good morning.
Mark Giannoni, Barclays just said 25 basis point cut in March next year, then in June, and that's it. 50 basis points in 25, that's your lot. What's the view of SocGen?
That's what the market's currently pricing in, is a December rate cut and maybe 2 cuts for next year. We still think that perhaps as the economy starts to slow down, the Fed will deliver as per the summary of economic projections. But there's really a lot of uncertainty around those around that call. And if anything, I think our bias is towards lesser cuts than what the summary of economic projections are showing.
Barclays is making some assumptions about the outlook, some assumptions about immigration, about trade. Do you think, for someone who's got to make a bond call, do you think it's too early to make those kind of calls? Or can we make some basic assumptions about what policy might look like from a Trump Volume 2?
I think at this point we have more questions than answers. So it's very, very challenging. And I've tried to go through that exercise in the last, 24 to 48 hours on coming up with forecasts for treasuries. And, my base case would still be that For the remainder of the year, 10-year yields are going to be somewhere between 4% and 4.5%. And then going into next year is when we're going to start seeing a lot more volatility on possible outcomes based on whether tariffs get passed, whether there's more fiscal stimulus from tax cuts, and if immigration, and to what extent they're able to implement some of the policies that they have been discussing during the campaign.
There's so much still to go. Still not to work out whether we actually get a trifecta from the Republican Party, whether they can secure the House. And then once we work out whether they've secured the House, we've got to work out how workable the margins will be, whether there's any resistance in the lower chamber to some of the policies we saw on the campaign trail. And then basically you've got to work out what that means for the bond market. And I think that's the challenge we had all week. I think you framed it correctly. Other people have done the same thing. You can view it as a clearing event, one, or you can view it as an event that redefines the macro outlook, two. And if you ask people at the moment on Wall Street, they'll have a mix of one and two, or one or the other.
Right. What it seems like is people in equities are saying it was a clearing event. And that honestly has been the takeaway that I've gotten from all the people we've spoken to. In bonds, it's more of a question mark. And I think Jim Bianco put it perfectly, which is we shouldn't be just accustomed to 15 basis point swings in Treasury yields at any given time as being the new normal.
So, Badra, how do you view it? Was it a clearing event, or does it redefine the macro outlook? Or is it still too soon to say?
I think it's too soon to say. But what the price action was in the bond market for this week was that we got through a key risk event. We saw volatility come down quite sharply once we got through the elections. The initial knee-jerk reaction was for a sell-off and a steepening of the yield curve, which is what a majority of the market was anticipating. But given the fact that the positioning was relatively clean heading into the elections, and the fact that the market was, quite almost fully priced in for a Trump scenario, I think what you saw after the election was for the market to take a little bit of a breather.
We also rallied on Monday, which probably didn't help. We rallied on Monday following that poll from Iowa over the weekend, which set us up to get kicked in the other direction.
Really, I mean, I think that's a great point, which is we had been pricing in something, then we priced it out, and then we priced it back in, which goes to this 15 basis point whipsaw action that we've been getting. Subhadra, you think that actually we're in a range here, and that people are getting over their skis talking about the potential for 5% Treasury yields in 10 years, and all of these types of more excessive potential moves. What makes you so confident at a time when some people are saying market participants are just waking up to the fact that this economy had plenty of inflation and growth already baked in?
So going into year end, I think it's going to be pretty much range bound. I mean, I think investors are going to be a little bit more cautious. You typically tend to see that heading into year end. But beyond that, you're really going to start seeing the market focus on the impact of tariffs. I mean, I think that if tariffs, in addition to the fact that inflation is already ticking up. We had 0.3 in CPI for the last print that we got, and then probably another 0.3 month-over-month for November in the print that we're going to get next week. I think inflation is still very much a concern. And then add to that any sort of fiscal stimulus that you could get from the Trump administration. There's a concern that inflation is going to be something that's going to be high and persistent next year. And in that sort of environment, it's going to be very, very challenging for the Fed to cut rates, aggressively, even if employment is starting to moderate. So it's going to be that sort of tug of war between what the impact is going to be on inflation and the dynamics around employment and growth.
So, Subhadra, the Fed may have to be on pause, but how quickly are we going to see the ECB move? Are they just going to be pedal to the metal?
I think that they're in a very, very tough situation because on the one hand, you're looking at the impact of tariffs, affecting Europe a lot more meaningfully than perhaps even China. And so they're going to need to kind of balance, that aspect of the impact of policies from the Trump administration. And then you also have to look at, changes, elections in Germany, and other sort of geopolitical risks and the dynamics around geopolitics changing quite meaningfully next year. So they have a very tough balancing act, but I think the bias is that the ECB cuts more than the Fed for next year.
Are they the biggest loser in this new regime?
You mean Europe?
Yeah.
Potentially, but we'll be watching to see what the specifics are and how much the Trump administration can actually pass, and what impact that would have over the medium term.
Subhadra, just a final question. How do you write an outlook for 2025? I was thinking of this earlier. Typically around now, they're already getting published. Obviously, we've waited for the US election, but how do you put one together? You just put various scenarios. What do you do? What are you and the team doing?
I must say this is going to be one of the most challenging years to come up with an accurate forecast for how things are going to pan out next year, because on the one hand, you have the dynamics of inflation, which could keep the front end, pegged, or there's also, people saying maybe they would not even cut rates or hike. There's that dynamic on the front end. Then on the long end, you have to kind of suss out what the impact is going to be on growth. Is it going to slow down growth? Or is that going to be inflationary, and you start seeing a meaningful rise in inflation expectations across the curve? So this is a very, very confusing environment to really come up with forecasts. So we'll be spending the next couple of weeks trying to suss out the probabilities.
I'm in the cheap seats. This is easy. Your job's super hard right now, looking out to 2025, that's for sure.
I'm just Googling where we can buy dartboards and how expensive they actually are.
Blindfolds.
And blindfolds, so that we can make sure to get our forecasts up in good shape for surveillance come, year end.
Super difficult. Subhadra, it's good to see you. Appreciate your time. Thank you. Subhadra Japatha of SocGen. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Tesla is now offering lease options for its Cybertruck. Prices start at $999 per month for 3 years for customers who put down $7,500. The EV maker introduced the lease option after working through the truck's back orders. Last month, Tesla told investors the Cybertruck was its third best-selling model in the U.S. in the last quarter. Rudy Giuliani has 1 week to surrender his assets. A federal judge said the former New York City mayor must turn over his Mercedes-Benz and a collection of luxury watches to 2 2020 poll workers. It's part of a $148 million defamation judgment. Giuliani told reporters the case is political persecution. Wells Fargo Bank analyst Mike Mayo says the election of Donald Trump is nothing short of a sea change for the industry. The Wall Street veteran telling Bloomberg, quote, "This has been one long, harsh regulatory cycle for banks. Now the expectation is for a paradigm shift that prioritizes economics over politics." The S&P 500 Financials Index has surged 30% since Trump was reelected earlier this week. That's your brief. John.
Hey, Danny, thank you. Thanks for this morning, and thank you for this week. Up next, we'll set you up for the week ahead, looking ahead to inflation data in America. From New York, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington. It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a...
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
The open in about 36 minutes away. Equity futures on the S&P just a little bit softer. Looking ahead to next week, before we get there, you've got this, and I know you're going to hang around for it. UMich consumer sentiment at 10 a.m. Eastern time. Mike's going to take care of all that. Then next week, Tuesday, Home Depot earnings, Wednesday, CPI, Thursday, PPI, and another round of claims, plus Disney Resorts, and Friday, retail sales as well. Mike McKee, so let's start with CPI. What are you looking for? And to Lisa's point, are we making CPI reports great again?
We're making CPI reports great again, but jobs will also play a role. We're getting back to the dual mandate worries that we had. CPI is expected to come in unchanged, basically, a little bit stronger on the monthly basis and unchanged. Well, the headline is expected to go up. Now, that's not a good headline for people's psychology. The Fed will look through it a little bit because a lot of it will be costs that went up because of the hurricane, used cars, lumber, stuff like that. But then we get another CPI before the next Fed meeting. So the Fed has plenty of inflation data to look at.
Are you excited for University of Michigan sentiment survey and the inflation forecast 5 to 10 year out?
I would be, except that this is 2 days after the election, so I don't think they had a lot of time to get data in, but I'm certainly going to ask Joanne Shu about that and whether or not it reflects. I mean, if you look at the sentiment by political party, it's like an X whenever the party changes power. So it'll be interesting to see if Republicans are all of a sudden thinking things are great and Democrats, well, we know they think things are miserable, but we'll see if it reflected in the...
Anne-Marie with quote of the week early this week. We've already had Michigan sentiment. We got it Tuesday night, Wednesday morning. Mike McKee, thank you, sir. Coming up on Monday, don't miss this lineup. Chris Harvey, Wells Fargo, Neela Richardson, ADP, IBM Vice Chairman, Gary Cohn, the former NEC director. Looking forward to that. Plus, Oksana Aronoff of JP Morgan Asset Management. From New York City, you are almost there. Enjoy your weekend. Thank you very much for choosing Bloomberg TV all week. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Okay, futures looking down a little, but it still could be the best week in a year for stocks. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Shanali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, big no, he won't go. Fed Chair Jay Powell says Donald Trump can't fire him, even if he tried.
And the Trump rally takes a little bit of a breather, at least for now. Futures look like they're giving back some of the big gains chalked up after the win sparked a risk-on frenzy across assets.
And who says that revenge travel, rather, is over? Online travel giants' results signal the post-pandemic boom still going strong. All that and more coming up, but let's take a look at these markets. A really interesting week, like Matt said, maybe a little bit of a breather. Maybe that post-Trump win rally went a little bit too far, at least that's what you're seeing in the market this morning. You can see the S&P 500 down just 0.1%. Those losses were a little bit steeper earlier this morning, coming back a bit. Same story if you take a look at big tech, your NASDAQ 100 down about 0.3%. And then take a look at the bond market. Take a look at that 10-year Treasury yield. We are currently trading at 4.32. That number was closer to 4.50 just a couple days ago, but at least for right now, we are unchanged on the day. Matt Miller.
Yeah, we're trading back to last week's level across the curve. This chart is insane. Take a look at it on your own Bloomberg terminal if you want. It's 1362, so you type in G, #BTV1362. It shows the premium investors are willing to pay for U.S. earnings over European earnings, and the spread has hit an all-time high. When is that going to turn around?
Certainly investors not betting against America. There are some single stocks they are betting against, though. We're going to look at Pinterest here. The outlook is spooking investors as the forecast is a drop in demand from certain advertisers. Pinterest down now almost 12% pre-market. I'm also keeping an eye here on Icahn Enterprises. Think this one is interesting. Carl Icahn, of course, is betting on deals, but he's cutting his dividend to do so at Icahn Enterprises. The stock of Icahn Enterprises now down 6% pre-market, but the reason he's doing it is for a stake in CVR. Looking at NRG Energy as well, boosting its guidance. EBITDA for the full year, the guidance beat the average analyst estimate. The stock now up almost 5%. Event-driven activity, earnings-driven activity, a lot to talk about.
Yeah, a lot to talk about. Doesn't it feel like Friday got here fast? I mean, what a week we have had. I mean, I just feel like the week has flown by. We had the election, all of a sudden we had a winner, then we had the best post-election rally of all time. We had the best Fed day this year in terms of stocks, and all of a sudden it's the weekend.
Okay, this week has felt about a year long, but I see your point. To the point, though, that you made on the best Fed day rally, it was interesting how little of an impact the Fed decision actually made, and the press conference as well. We got some spicy headlines out of Jerome Powell, but markets were up before that. They barely moved. It was really all about the Trump trade this week, and now maybe the unwind.
If everyone was excited about all the action earlier this week, you actually now not only have bond market volatility much, much lower, almost at the one-year average, you also have the VIX below the one-year average. So that is just how much the markets have calmed down from 2 days ago.
All right, let's get to our guest out of Newport Beach. Erin Brown joins us from PIMCO, where she manages a portfolio. And Erin, I got to ask first about the Fed. As Katie mentioned, the markets didn't move at all. They did remove some language from the statement, no longer saying that they've gained greater confidence in inflation moving sustainably towards their target. Do you think they're laying the groundwork for a pause?
I think the Fed right now is very much in a data dependency state, in which they're really looking at the culmination of data that's coming out meeting to meeting, but also obviously over a 3, 6 month and 12-month period to really understand what is the evolution of the data. They're in between, as Jerome Powell mentioned, in between summary of economic projections right now. They're not going to refresh one until the end of this year. And so I think as a result of that, they're really very much in a data dependency stage, and will decide whether or not to cut 25 basis points in December after we get a couple of more data prints on payrolls as well as on inflation.
You know, it's interesting. As there is caution coming out of the Federal Reserve, the bond market is still reacting so heavily to politics, and who knows what the ultimate policy might look like. We're still also waiting on the final outcome in the House. How do you think about the bond market's moves from here? We have erased almost all of the losses since Wednesday. We're still a little higher than we started the week, Erin, but not by much in the 10-year yield.
Right. Well, a lot, I think, has been priced in prior to the election with respect to the bond market, and the bond market was already anticipating that Trump would win. And so I think that as a result of that, you're not seeing the same follow through in bonds as you are seeing in equities, which are still pricing off of what has been a very good earnings season. I think with respect to bond markets, from a medium-term perspective, bonds at the current levels that they are right now, we think offer really good value. There's going to be some volatility around sort of a range, but we think that we're, as we approach sort of the mid 4% and above level, that's a really good value to start to buy bonds again for longer term or medium term investors. I think as it comes to, between now and year end, the market is going to remain fairly tightly range bound, really just in anticipation of what could be a more stimulative future in 2025 and beyond.
Erin, let's talk about the relationship between bonds and between stocks. I was having a conversation with Bob Michael over at JP Morgan yesterday, and he said that once you have Trump actually enter office, return to the White House, when some of these policies actually come to fruition, you could see the 10-year Treasury yield maybe knock on the door of 5%, and at that point, that is a very difficult level for stocks to absorb. How are you thinking about that relationship, particularly because it seems like nothing is slowing stocks down right now?
So I think what matters is really the pace of the bond market sell-off. And if we start to see the pace accelerating that of growth, so you're seeing real yields rise at a faster pace than growth, that's a point when it really starts to eat into equities and starts to hurt equities. We've been in an environment over the last couple of years where bond yields have been well above 5%, and equities have still done well in that environment. So what matters, and what I would focus on as an investor, is the pace. Are we seeing growth that is, helping to absorb some of that shock of higher rates? If the question is no, and you're seeing rates sell off significantly and growth isn't really moving, that's the point where equities really start to get hurt.
Can you look at, Erin, the blueprint from 2016 and make some moves in your portfolio for 2024? Have you done that post-election?
Yes, of course. And I think that the whole market is really looking at what worked in 2016 and what the sort of corollary could be for 2025 and beyond. What I'd say with regards to that is one of the things that we're looking at are stocks that are really exposed to tariffs, that where we could see, more heightened sense of tariffs, or at least threat of tariffs, really start to eat into earnings because they rely a lot on imports, versus stocks that are more insulated from tariffs, that are more domestically oriented. And we think right now is the time to bet on the U.S. So betting on companies that don't have a lot of exposure to imports, that are really geared towards the U.S. and the U.S. consumer and businesses, we think are going to likely outperform over the next couple of years. And we think that the policy directive from a second President Trump presidency is really going to be geared here onshore, geared towards lifting the U.S. at the expense potentially of other countries.
Tariffs seem to be a near certainty, and I think the degree of which you see them is really what's still sort of in the air until he comes out and really makes a more significant declaration now that he's actually won the election, right? So how do you think about how long or how short you make that trade around tariffs, in particular when you're thinking about the stock market here?
So firstly, we think that the threat of tariffs is a near certainty, not necessarily tariffs itself. And certainly we are going to see, continued focus on tariffs in the market over the next year and beyond. But I would be hesitant to just throw the baby out with the bathwater and sell stocks, unilaterally, just because you think that, there's going to be a significant tariff impact starting next year. Firstly, we expect that the threat of tariffs are probably going to start pretty early on. That said, we also think that there's going to be room for negotiation. And what President-elect Trump has said, is that he's going to use tariffs in order to try to extract leverage and concessions out of some of our trading partners. And we think that pressure is really going to be a threat, which could be implemented, but it will be implemented if the concessions aren't met. So all of that said, I think you want to be very focused on your portfolio, which companies are most exposed to imports or have significant trading relationships where their earnings and margins would be hit materially if we were to see tariffs imposed. And some of that can just be done on a sector level, similar to what we saw last go around. But I think that those companies that are really exposed to China imports in particular are ones where they're going to have challenges, I think, with respect to earnings in the quarters and years ahead if we were to see significant tariffs imposed.
And Erin, when you add this all together, of course, we've been talking a lot about the political landscape, what proposals, promises might actually turn into policy. But when you take a look at corporate America, what we've learned throughout this earnings season, where does that leave you with conviction when it comes to the sector level of this equity market?
Sure. So corporate earnings have been actually quite solid, and we've seen from a number of consumer companies comments around the consumer actually starting to ramp back up as we came into the third quarter of this year. There was a lull or a period of weakness that was experienced over the summer with respect to the U.S. consumer. That seems to have been resolved, and we started to see more positive data coming out from some of the consumer companies starting in September of this year. And that's on the back of what is still a very healthy corporate environment for businesses in America. So we're still seeing a fairly healthy environment for the U.S. And the U.S., I think, is the best of the bunch amongst DM right now with respect to corporate earnings growth and the health of the consumer. So where that leaves me is really focusing domestically on the U.S. We really like companies that are pretty well insulated, as I mentioned, from some of the weakness that we're seeing from the rest of the world with respect to China in particular, and also that are more insulated from tariffs. Mm-hmm. We think that the power AI trade still is really good, and utilities is a place to invest for next year.
Erin, we thank you so much. Happy Friday to you. We appreciate you joining us this morning. That is PIMCO's Erin Brown. Now let's get a look at some stocks moving ahead of the opening bell. Bring in Abigail Doolittle.
Let's start off with the shares of Airbnb, and they're doing a tremendous reversal because in the after hours when this company reported, the stock had been up more than 10%, now down nearly 7%. So investors really changing their mind. What they liked was the fact that they beat earnings. In addition, the fourth quarter nights booked growth better than expected. On the other hand, as analysts and investors parse through the details, it appears that investments are going to weigh on margins. This stock right now down about 7%. Turning to the shares of Docuity, though, not so much. Absolutely soaring right now, up about 35%. They beat in a big way. Earnings of 30 cents, 18% better than what analysts had expected. Sales 8% better, so a strong quarter reported. Plus, they raised the forecast. There is a 9% short interest, so some of this gain probably a short squeeze. And then finally, turning to the shares of DraftKings, the betting company. Well, it's also reversed. Earlier, it had been down, now up about 0.5%. They did miss both earnings and sales. They cut the full year forecast. NFL game outcomes, quote unquote, customer friendly. They're saying that there's an impact. We'll be digging into what turned this stock around and watching it and reporting on it all day long, Matt.
All right, Abby, thanks very much. Abigail Doolittle looking at some of the stocks that are moving on this Friday morning. Coming up, travel stocks prepare for turbulence this holiday season. We'll talk about those bookings and whether or not you're still taking revenge. This is Bloomberg. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Let's get out of high interest and look at what's making headlines around the world. German Chancellor Olaf Scholz is facing increasing pressure to hold an early election in January. A new poll shows that 65% of voters want a national ballot as soon as possible. Earlier this week, of course, Scholz fired the country's finance minister, Christian Lindner, citing divisions over Germany's economic revival, if there is one to be had. The crisis comes as Germany's economy stagnates and the country grapples with the re-election of Donald Trump. That raises the prospect of a new transatlantic trade war, even as their auto industry is already ailing from Chinese competition. Boeing CEO Kelly Ortberg is trying to patch up relations with workers after a bruising 7-week strike. He says the company will pay employees who were put on mandatory leave during the disruption at the Seattle manufacturing hub. The gesture of goodwill signals the CEO's attention has shifted towards mending operations. He tries to get aircraft output back on track. And Levi Strauss heir Daniel Lurie is set to become the new mayor of San Francisco, pushing out incumbent London Breed. Lurie positioned himself as a political outsider who could best tackle the city's homelessness, drug problems, and crime. His election underscores broad dissatisfaction with the status quo in San Francisco, a longtime tech boom town that has been struggling to recover economically from its trip way left into the pandemic. Katie?
All right, let's focus on shares of Airbnb this morning. They're actually falling right now. That's after posting double-digit gains in earnings. It had mixed results with book nights topping the street's estimates, while its investments were seen to weigh on margins. For more, let's bring in Bloomberg Intelligence senior tech analyst Mandeep Singh, who also covers Airbnb, which is a particular delight. Walk us through the reaction to these results, because you take a look at the after-hours trade. Airbnb was up 13% at one point. Obviously, a different story this morning.
Yeah, I mean, the forward guidance was quite constructive. They said fourth-quarter growth would be better than third quarter. So clearly, they are expecting room night growth to inflect here, and the travel demand would take that growth higher. What Brian said on the call was they're looking to invest more to drive, new products that can generate $1 billion in revenue, incremental revenue every 2 years. Now, that's where I think investors didn't have enough clarity on what exactly is he talking about in terms of investment, because the biggest criticism for Airbnb is it's still a niche company when it comes to travel, alternative accommodations. They don't have the complete bundle that your Booking and Expedia have, and I think that's where more clarity would help. But other than that, the print was solid.
Well, you think about Expedia, for example, it's up now more than 4% pre-market, and the divergence between the two. How much of a moat does Airbnb have? How much room is there for others to catch up in a much greater way? How do you fix that gap?
I mean, look, Airbnb trades at the premium multiple when it comes to travel market. So when you compare it to Expedia, Expedia trades at a much cheaper valuation. And so the print was solid, but in terms of, the free cash flow that Airbnb generates versus the rest of the peers like Expedia, it's far ahead. And that's where, their moat is sustainable, because the biggest thing with online marketplaces is supply growth. And when it comes to Airbnb, it's got that unique supply of, these vacation rentals that nobody else has.
It's practically a monopoly, right?
It is
a
monopoly.
There's Vrbo. Is there really any competition?
I mean, in terms of listings, and Brian emphasized the quality of the listings last night, it's not even a comparison. So clearly, Airbnb is way ahead. And when people talk about, disruption from generative AI agents, changing the way people book travel, it's so hard to acquire supply when it comes to online marketplaces. That's why you don't have Google as a competitor to Airbnb, because supply acquisition is the hard part. So I do think Airbnb's problem is the saturation in vacation rentals market, which is what Brian is trying to address. And he alluded to, the fact that they'll be launching a lot more newer products, but there wasn't enough clarity on what are the areas they'll be launching new products on.
All right, Mandeep Singh, it's always great to see you. Of course, that is Mandeep Singh of Bloomberg Intelligence speaking to us about Airbnb. Let's bring you some breaking news. This from Bill Ackman in a post on X, saying that he is seeking to remove Pershing Square Holdings from Euronext. Of course, this is the Amsterdam exchange, seeking instead to concentrate the listing on one exchange, the London Stock Exchange, which he says in the post now represents more than 90% of our trading. Also in this post, guys, he says that events in Amsterdam during the last 24 hours provide an appropriate tipping point for this conclusion, of course, after Israeli football fans were attacked in Amsterdam.
I mean, that's not, of course, I had not heard that until you showed me the story. So I think a lot of people will not know this. Dutch police have arrested 62 after attacks on Israeli football fans. Of course, Bill Ackman has been front and center when it comes to anti-Semitic his concerns about anti-Semitic protests in this country and anti-Semitic violence over in Holland. So I think this is a pretty interesting story. He's going to focus now just on London.
Right. Well, two things about that. To your point, this is both about business as well as about politics. He says it's a site to protect tourists. He wants to move to a place that's more friendly to minority populations, to your point. Also want to cite his conversations with Universal Music Group as well, which is domiciled in Amsterdam. He says that Pershing Square has a contractual right to cause Universal Music Group to be listed in the U.S. You're actually seeing UMG shares up after his tweet as well. The case he makes is that UMG trades at a large discount to its intrinsic value because of limited liquidity, in part by not having a U.S. listing. Katie, I know you're watching this very closely, the changing of listings. A lot of people betting on U.S. markets. Bill Ackman capitalizing on that.
Yeah, well, two different things. This, of course, is the closed-end fund that has existed in Amsterdam for several years now, separate from the closed-end fund he's trying to launch in the U.S., but like you said, a blending of business and politics here. Like he says in the Post, already 90% of the trading in London, but now, of course, trying to move the listing altogether following Amsterdam.
All right, we'll continue to follow this story for you as the news breaks. We're covering the market, obviously, front and center here. Just 7 minutes to go until the start of trading, and this could be the best week in a year for stocks after an historic presidential election. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Earnings. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg.
All right, 4 minutes to go until the bells ring. You take a look at futures right now, still red, of course, in terms of the direction, but on the S&P 500, really bringing back those pre-market losses. We'll watch that and discuss with Amy Wu Silverman coming up next. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. If we don't fall 0.2%, then we're going to have the best week in a year for stocks. Not that that matters. It's just one of those fun superlatives, like Wednesday was the best post-election day for stocks in recorded history, for the S&P, I mean, and yesterday was the best day for stocks on a Fed day in 2024. You hear the opening bell. There are some people ringing. Apparently, Roberts Ryan is ringing the bell for Veterans Day. It's a veteran-owned business down the New York Stock Exchange. Of course, Veterans Day isn't until Monday, and they're going to keep trading. I think it's kind of disrespectful to work and trade on Veterans Day, but we're going to do it anyway. Crane shares ringing the opening bell on the NASDAQ. In terms of the indexes, it looked like we were giving back a little bit of the gains, Katie Greifeld, that we have built up, the big gains, more than 4%. Over the last few trading days, but now the S&P is positive. What do you see?
Yeah, the color is green behind me if you take a look at the S&P. Like you said, this is a week that's rich with superlatives, and as such, maybe we're taking a little bit of a breather today. You take a look at these numbers, really small moves overall after all the fireworks that we saw this week. The S&P 500 higher a little bit, the NASDAQ 100 deciding what to do on your big tech names. Same thing, too, if you take a look at the small caps. The small caps have really led the charge this week, but now a little bit of a breather. Meanwhile, you take a look under the surface, and we have to talk about Pinterest. Just a wipeout underway. Sales, of course, for the holiday quarter are lower than expected. The company cited weaker demand from food and beverage advertisers, currently off about 14% on shares.
Katie, I'm also keeping an eye here on DraftKings. I think this is an interesting one. It cut its full-year estimate for 2024 as revenue and profit because of gamblers getting lucky in the first part of the fourth quarter. I think that's fascinating. I'm a gambler myself, and it should be paying out. Stock was down. Now it's up about 1% as the market opens.
How much do you typically bet in any given month, Shonali?
Just a few bucks, Matt. Nothing crazy. And in fact, I have stopped myself from any parlays.
That's good. That's good. You don't ever want to do anything.
Limits.
Yeah, like that, with a French name. Lucid posted a better than expected loss after the EV makers push to cut costs gathers momentum. The company just started taking orders for its Gravity SUV, which you see in this short clip here. I'm not sure it's a terribly attractive vehicle. It kind of looks like a Honda, Nissan, Toyota, like a short Odyssey. I'm not really pumped on it, but the stock is up, and it hasn't gotten killed by Tesla competition over the last few days, which you may have expected post-election. Let's take a closer look at where traders are placing their bets this morning. For that, we go to Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, this, of course, has been the week of the Trump trade, and here it is with the S&P 500 up more than 4%, the better part of 5%, in fact, the best week in about a year as investors are cheering on the idea that President-elect Trump, his potential policies of tax cuts and protectionism will be good for the U.S. economy. But it's not just the S&P 500. The Russell 2000 posting its best week, or heading to its best week, I should say, since February of 2021, up 7.7% right now. Bitcoin up a very healthy 9.9% on the expectation that Trump's administration will be friendly toward the crypto space. It is interesting, though, we did have on the day after the election, the best day for the Bloomberg Dollar Index, up more than 1% since 2020, now a very small decline there. And then the 10-year yield, which actually had been soaring as well on the idea that some of the budget spending, spending may not be so friendly toward bonds and yields, but right now down about 8 bips, 9 basis points. That could also have to do with the Fed cutting once more. And then when we put it all together, Katie, for some of the stocks that are either linked to Republicans or Democrats, well, on bottom you can see the democratically linked stocks have really plunged. This having to do with the idea that there could be a trifecta in Washington for the Republicans, and then the Republican-linked stocks off of the highs, but pretty close net on the close of this week, or at the open of the close of this week. We do have stocks, again, cheering that Trump trade.
Abigail Doolittle, thank you so much. A great setup for our conversation now with RBC Head of Derivative Strategy, Amy Wu Silverman. And Amy, this has been a week that's been defined, at least in the markets, by that Trump trade. Of course, all that enthusiasm behind it. And now today, maybe a little bit of an unwind. When you take a look into the options market, when you take a look at positioning, how much more steam is there in this trade?
Hey, Katie, look, I think that is certainly the question of the day, if not the question for the next few months. Look, one thing we've been talking about is when you looked at the first half of this year, the narrative was really about AI, about mega cap tech. And you really saw that in the options positioning. People felt like they had FOMO. They felt like they couldn't miss out. And so you saw a lot of call buying. You saw that right tailwind being really important. The reason I bring that up, Katie, is we continue to see that in the Trump trade, even though we've had these substantial moves. So I think, 9 out of the 10 conversations I've been having is, how much room is there left in IWM? How much room is there left in all these Trump baskets? And when you look to the derivatives market, you still see relatively healthy bullish sentiment there, which tells you that momentum, maybe it flags for a little while, but it certainly could still continue.
Well, to that end as well, when you see momentum picking up, what does it mean for volatility? Because the drop-off you saw in the VIX has been pretty stunning. It's been hanging out closer to 20 for a little while. Now it's back below 15.
Yeah, you're exactly right. And if you kind of remember, a couple days prior to the election, there was a massive volatility premium, almost 2x what the average VIX level has been this whole year. And, we've gone back down from that psychological 20 handle or back to 15. Here's one thing I'll say that I think investors forget, and this is what it is. You can have the stock market move up and volatility move up. It's actually a dynamic that we've seen a lot more post-2020 where we say spot up, vol up, because look, when people buy call options, it's still moving volatility up. And so those things are not necessarily mutually exclusive because that correlation of, VIX up means stocks down, that has not been true. And so look, if we do see a second wave, that could still mean that volatility is rising, could see that VIX handle rising, because ultimately VIX is just a compilation of the weight of S&P calls and S&P puts.
We had polls that were horribly wrong once again. Betting markets we weren't too sure about with regards to the election because there was a big whale in one and you could only buy in if you had crypto, and the other one only had an $850 limit. So there was a question mark there. You say the options market really gave us the answer. Lay out how you could see in the options market that Donald Trump was going to win by such a wide margin.
Yeah, I would say I've been personally very fascinated by this dynamic, in particular because the polls have been so incorrect to the magnitude. And you brought up the whale trade. I thought the whale trade was very interesting because not only was that a bet on Donald Trump winning. It was also a bet on him winning the popular vote. So it's a very specific bet. And it all comes down to what was it that was missing in the polls that was priced by derivatives, that was priced by the probabilities in the options market. One thing we saw, just to give you a characterization, is that while the election was still ongoing, so polls hadn't closed yet, we saw the biggest crush in volatility risk premium. And then we saw these Trump baskets start to trade up. We saw the right tail volatility start to trade up in IWM. So the market was very strongly pre-trading a conclusive Trump victory the day of the polls. The polls hadn't even closed yet. And that's a very interesting signal to me, because right now, we're still waiting on the House. But the market essentially is still continuing to trade as if we're going to get a Republican sweep. And, one question I have going forward is, if people start believing that the polls are not reliable, what are your secondary signals? And it does seem to be that equity markets and equity volatility has been more efficient here.
Yeah, you make several good points there. First of all, like on 7 p.m. on election night, it was just wild to see markets take off. And to your point, it's a big vindication for the betting markets, but also for the volatility markets. And I'm curious how the volatility market, particularly intraday volatility, might evolve if we see Trump return to Twitter, return to X in a big way. If you think about 2016 on, it felt like every day could be dictated by whatever Trump tweeted that day. Are we returning back to that market?
Yeah, you're absolutely right. I was kind of laughing because I have like a special blip on my Bloomberg screen that will just start to highlight the Trump tweets again, because we'll need that for all the volatility that will come. I would say that the one kind of question that our investors have been talking about is we've had this knee-jerk reaction where, VIX has sold off, volatility has sold off. But there are certainly a lot of questions of whether or not it should be higher, because in the 2016 to 2020 regime, you do get these big volatility pockets as it comes down to Trump and, the way he kind of delegates information and makes surprise choices. A simple example I'll give you is just when he tweeted about Deere. And you saw idiosyncratically what that stock did. I think when we speak with portfolio managers, that's the kind of angst that they're bracing for. And it's difficult to hedge those kind of risks because they're not necessarily catalyst dependent. They're really, much more whim dependent. And so how do you price and how do you scale volatility in that situation?
Amy, we thank you so much for joining us today. Watch out for maybe some more volatility. We'll see it's low today, but who knows what's ahead. RBC Head of Derivative Strategy. Now, coming up, Pinterest posts a week holiday forecast. We're going to give you details of that next. This is Bloomberg.
in case you missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies, where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, is the fact that if you can do it, you're one of the few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
The countdown is on. Everything you need to Get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Open Interest. Let's take a look at this stock market right now, because at least the S&P 500 a little bit higher right now, to the tune of about 0.1%. We are close to up by 4.5% on the week. Of course, that would be the best week of this year, so keep your eyes peeled. It's time now for our top calls, some of the analyst action in focus this morning. Let's start with Telsey Advisory Group, upgrading Home Depot to a buy ahead of the company's earnings next week. The analyst says that the DIY home retailer could be a beneficiary of the Fed's latest rate cut. Next up, we have Barclays downgrading Bath & Body Works to a sell, also cutting its price target. The analyst says that there's a risk that sales will slow because of the weakening economic picture, so a little bit different attitude there. But he also notes that the company could underperform the broader retail sector. And finally, we have Goldman cutting its recommendation on Sweetgreen, saying it's no longer a buy. The salad chain reporting disappointing third-quarter results thanks to higher labor and protein costs. Sweetgreen hasn't turned a profit since it went public in 2021, Matt. I know. All that money we spend there, and it still can't turn a profit.
That's insane. I'm paying like $18 a salad there almost every day, and they don't turn a profit?
Not yet.
Man, I just wonder, where do you have to price a salad to be profitable? If not $18, what are we talking about, like 25, 30?
Protein's really expensive right now.
All right, fair call. All right, let's get to some more earnings news. More disappointment here. Pinterest shares plummeting after forecasting low sales for the holiday quarter, citing weak demand from certain advertisers. Let's discuss with Bloomberg Technology. Co-host Carolyn Hyde joins us here on set. To me, it's always been fascinating, Pinterest, because it pops up in my internet searches a lot, and I go to buy stuff, and I'm always disappointed because it's just like some lady's collection of jackets she likes, right? They're trying to change that. They're trying to boost buyable content, but it doesn't really seem to be working.
Well, I think they'd argue that it is working and that people come there with intention, that people go there because they're getting married, because they're refitting a house, they're having a baby, and therefore you go for their products, you search, and they are trying to therefore invest in AI, generative AI, that much more, so that you can more seamlessly get the content that you want, find the images that you need, and eventually will be shoppable, more shoppable. And that's certainly been why advertising has been drawn to it. Look, the shares are plummeting. This is after, actually, they had a pretty nice third quarter, and they had double-digit growth in terms of users. Maybe Matt's one of them, a new one that they've just added in terms of monthly active users. Loads of them are outside of the US. You've got about 300 million outside the US, 99 million here in the US. But they are managing to see double-digit growth in revenue. You are seeing 40% increase in earnings per share, and they guide for more double-digit growth in revenue going forward.
But Caroline, their shares were down 8% year to date, and this has been a pretty damn good year for stocks. So something is not impressing the market.
And what's interesting is also their valuation is way lower than like a Meta or a Snap in terms of forward price versus future earnings. So why are people still questioning? The cost of generative AI is a lot. Look, they're upgrading the operating expenses are going to be up to $510 million for the fiscal fourth quarter. So we are seeing that they're having to plow money into generative AI, and people want to see, to your point, Matt, when are we going to get the shoppability? When are we going to see advertisers rate Pinterest at the same as a Meta when they're going for Instagram, when the same as going for other competitors in the space? Because many feel that sometimes it's a bit of an also-ran when you're putting ad dollars to work.
Yeah, it's a good point, too, that you make on valuation. Though I will say I was surprised this morning to see that its market cap is still above $22 billion. Not what I would have expected. But
it's got loads of users.
It's got
way more users than X, for example.
Right, but expand on the competitive landscape a little bit more when it comes to ad. You mentioned Meta, you mentioned Snap. I have to imagine that when they're trying to chip away at that, that's a tough hill to climb.
It is, and I think when all marketeers are out there spending, all boats rise. But to your point, you were pointing out earlier when you looked at the share price plummeting the first point after trade opened, it is about food and beverage. I mean, who knows what's happening at Sweetgreen, but ultimately these companies, this is a result of the election. A lot of people are strapped for cash. People aren't spending as much on a Coca-Cola or particular some of the CPG units, and therefore we're likely to see maybe just a bit of a drawback going into the holidays. Also, maybe just the market got ahead of itself.
To your
point, it was
point,
really exuberant.
Seen that before.
To your point, they have tons of users. There are assets here.
It's a different kind of user than an X user, right?
Well,
Can you really make the comparison? People live, sleep, eat, and breathe X.
I don't.
The more,
and I'm still a user.
The more that you see the price drop, how much more does it become either a acquisition target or an activist target?
Oh, well, from a perspective, I'm sure that the investor base are one that they're going to be having to talk to a lot about whether or not this is vindicated in terms of the purchase price. But I mean, I'm going to go on to analyst recommendations. Overall, people have been relatively buoyant. We're seeing a lot of price targets cut come today from some of the analysts out there, but a lot of them still have a buy. 30 of them have a buy, 0 have a sell at the moment. So whether or not they see potential opportunity for this company to just re-accelerate into the second half of the year, I think many feel that they can return this one around when it comes to the view on advertising spend going forward.
Caroline, we thank you so very much. That is Bloomberg's Caroline Hyde, of course, co-host of Bloomberg Technology, which is on right after the show at 11 o'clock. Don't miss it. Coming up, BlackRock. We're going to talk about its talks with Millennium for a minority stake. But will it result in a deal? That's next in our Wall Street Beat. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome back to Bloomberg Open Interest. It's Friday. It's been a crazy week in the stock market. You wouldn't necessarily know it by looking at the action today, a little bit more muted, but some interesting trends developing. You now have the S&P 500 firmly in positive territory, up about 0.2%. The NASDAQ 100, it's trying to go green. It seems like it got there, at least for this exact moment. Pretty much unchanged on the day, though. And small caps also fighting back as well from their pre-market losses. The Russell 2000 currently higher by about 0.2%.
And Katie, it's time now for the Wall Street Beat. BlackRock is in talks with Millennium to sell a minority stake in the hedge fund. If a deal comes to fruition, it would be the first time in its 35-year history that Millennium had sold a portion of its business to a third party. Joining us now is Bloomberg hedge fund reporter Hema Parmar, who, has been following Millennium very closely. It has been changing a lot over the last couple of decades, certainly a lot in the last few years. When I think about BlackRock and I think about Millennium, both leaders are thinking about the future of finance, the holes that they're filling in the financial industry. Millennium stepping up in a bigger way into really the market-making hole that banks are leaving behind. BlackRock sees that. What's the rationale as we know it?
Yeah, so if we look at it from the BlackRock point of view, this is a firm that is getting bigger and bigger, is pushing more into alternative finance. You've seen them trying to buy HPS. And if we see this deal, if it does come to fruition, we should say these are early stage talks. We don't really know how it will pan out. But this could be seen as a way for the firm to get bigger, to become a one-stop shop for all things, including having some access to a sizable hedge fund.
Let's talk about Millennium a little bit more. Like Shonali said, this is a company, a hedge fund that's been changing. You think about their assets. I thought it was so interesting that they tried to raise as much as $10 billion, but they were oversubscribed. I mean, Millennium, it seems like everyone wants a piece.
Exactly. Over $20 billion of demand, and they capped it at $10 billion, which is still a huge amount of money. So you can see that there's a waiting list of people trying to get into Millennium. And you can see that this is a firm that has posted pretty strong returns almost every year that it's been around. And so they're sort of highly looked at. But what's interesting with these talks is that this is the first time that Millennium would have ever had sold a portion of its firm in its 35-year history. So, and you're seeing this is a firm that has been institutionalizing itself in some ways. The leaders at the very top are now essentially an office of the CIO.
So, it's a $70 billion hedge. Sorry, did you?
Well, yeah, one thing I had to ask about, too, is the succession here, because to your point about institutionalization, who are the people under the hood? They've been making a lot of changes, and I think that matters as they potentially have this talk with BlackRock, because what happens one day if Izzy Englander steps aside?
Right. And so if we look at the firm, for a long time there was, chatter about, okay, it being one person, whether it be Michael Gelband, who has left, or somebody else. And now if you look at the firm, it's with this essentially a office of the CIO, multiple people at the top running the firm, it feels more like a larger, mature firm run by many people and less potentially personality driven. Though I should say Izzy Englander is still at the top and still running things, of course.
Thank you so much, Hema, for joining us on this story. I thought it was a big story for Millennium, but for BlackRock, I mean, this is a $70 billion hedge fund. What does BlackRock have in assets under management? 10 trillion?
$11.5 trillion.
$11.5 trillion. That's a drop in the bucket. Are they making a ton of money, Millennium? Are they beating the benchmark?
Fees. It's about the fees.
Is it still 2 and 20?
Well, is it? Yeah, higher.
More than that.
For Millennium,
pass-through fees are expensive. So it's definitely more.
Millennium and Citadel, these are the two biggest multistrats, and they are largely considered the future of finance in a lot of ways, especially as bank trading desks shrink. And so if we think about BlackRock's next move here, this is just as much about positioning for the future.
BlackRock wants to make more money. BlackRock wants to get into private assets because they earn nothing on those ETFs. It's a story as simple as that.
I get it, but I mean, if it's the future of finance, I feel like, why isn't it way bigger than a measly $70 billion? You know, we trade $3.5 trillion companies.
They have to turn people away to keep it to $70 billion.
That's a very good point. That's a really good point. If it gets too big, it's much harder. All right, we're going to continue to cover this kind of stuff in Wall Street Beat for you. And we have a special Wall Street Beat interview in the next hour. Perella Weinberg CEO Andrew Bednar is going to join us. That will be a fascinating chat about M&A. Plus, we're going to talk about the consumer, a Tanger CEO, Stephen Yaloff, as well as Affirm's Max Levchin. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Police in the Netherlands say more than 60 people have been arrested after attacks on Israeli soccer fans. This woman in Amsterdam wrapped herself in an Israeli flag today.
I just woke up today in 1938, and I felt the urge to come here with my flag to show my people that they are not transparent.
Reporter Lauren Kamato from the Dutch capital.
The Prime Minister, Dick Schoof, has promised that the perpetrators will be tracked down and persecuted. They're looking to see if this was an organized thing or if their tensions are extremely high in the city and how it could have happened.
Police say 5 people were hospitalized. Lives upended north of Los Angeles, where a massive wildfire has destroyed about 200 homes.
This man fled his home and is living in a Red Cross shelter in the town of Camarillo. Even though he's lost everything, he's hopeful.
Just trying to stay positive. There's a silver lining in everything. And instead of writing a new chapter, I'm going to write a new book.
Saeed Sikder is also in the shelter. He said the fire moved so quickly.
I lost my everything, every single piece of my documents, everything. My money, everything.
The cause of the fire hasn't been determined. Christopher Cruz, CBS News.
Firefighters are hoping for calmer winds today. President-elect Trump has begun filling out his White House cabinet. He's chosen his campaign manager, Susie Wiles, to become the first female chief of staff. CBS's Robert Costa.
She has always been known as an operative who is low-key but really good at dealing with politicians who have these enormous personalities, who want to do things on the public stage in a certain way.
Police in North Carolina believe they've gotten to the bottom of a series of random shootings. CBS's Jim Krasula.
Raleigh police have arrested a 23-year-old North Carolina State University student identified as Andrew Granny in connection with a series of shooting incidents over the past week. 12 vehicles and houses were hit by gunfire along and near Interstate 40. One driver was shot and wounded in a leg.
Buses, subways, and trolleys still rolling in Philadelphia after SEPTA workers threatened to walk out at midnight. Union spokesman Brian Pollitt.
We decided not to go on strike. We decided to continue talking. The possibility of a strike is still there.
The union wants a 1-year contract with a 10% raise. The bells are tolling again at Notre Dame in Paris. Tourists delighted as they rang for the first time since a fire devastated the historic cathedral in 2019.
I was here when it burnt down. It was very sad. I'm glad it's finally coming alive again and will be used by the public.
The Dow is up 124 points in early trading. This is CBS.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Well, you made it to the end of the week, and what a week it has been. We do have a little more clarity on the makeup of the new Congress and the new administration. Erica York of the Tax Foundation, she's going to be here with a look at new tax policy. We're going to head to Ann Arbor in just a moment with Joanne Shu for the University of Michigan Consumer Confidence Survey. And Geeta Ranganathan at Bloomberg Intelligence is going to be here to go over Paramount's earnings. I'm John Tucker, in for Paul Sweeney, along with Emily Griffeo. Hi, Emily.
Hi,
Happy
John.
Friday. In for Alex Steele. And this is Bloomberg Intelligence. Let's get you set up right now. And for a quick look at the markets, we are joined by Bloomberg's Lisa Mateo, who's filling in for me, I think.
Yes, I think it's kind of strange, right? Market Drivers brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast. Get started today. All right, we've got little movement in stocks. This is at the end of a best week in 2024. This is after Donald Trump was elected president. We also had a Fed unanimous decision to cut interest rates by a quarter point. Fed Chair Jay Powell said he doesn't rule out or in a December rate cut. Meanwhile, you have Goldman Sachs changing its 2025 Fed call, seeing a slower pace of cuts. Now, we had some more economic data out today. Right now, we're starting to get a read on sentiment from the University of Michigan. The survey was for 71, came in higher at 73. The prior was for 70.5. John and Emily are going to break that down in just a bit. Right now, we'll get to the stock market. The NASDAQ down 0.1%, 24 points, 19,245. The Dow up 0.3%, 140 points, 43,870. The S&P 500 down 0.1%, 11 points, 5,984. The 2-year yield at 4.21%, up 1 basis point. The yield on the 10-year, 4.29%, and that's down 4 basis points. Paramount reported big gains in streaming subscribers third quarter, but overall sales, well, they were weaker than expected due to declines in TV and film revenue. Right now, their shares are down about 4%. And Pinterest down 14% after a weak holiday outlook. And EV startup Rivian maintained its profitability target despite a parts shortage, but maybe investors were hoping for a little bit more. Rivian down about 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash.
All right, Lisa, thanks very much. Well, the latest reading on consumer confidence just out, in fact, reaching a 7-month high. Let's break it down right now with Joanne Shu, the director of the University of Michigan Surveys of Consumers, joining us. You're in Ann Arbor, right?
That's correct.
It doesn't necessarily reflect the outcome of the election because it looks like pretty confident, people were pretty confident about the economy of the U.S.
That's correct. So I want to note that the data that we're releasing today, the interviews ended on Monday prior to the election. And so what we saw on the eve of the election, in the 2 weeks leading into it, consumers were feeling much more confident about the future of the economy. Not much change in current conditions, but in terms of the future of the economy, we saw improvements in terms of business conditions, personal finances, people's incomes, unemployment rates. Consumers were really feeling like the future of the economy was on an upward trajectory.
Joanne, what did the survey tell us about how Americans are thinking about the future path of inflation?
With inflation, we saw a very slight decrease in short-run inflation expectations, as well as a very small increase in long-run expectations. So consumers are broadly expecting inflation to continue stabilizing. They continue to be pretty frustrated by high prices, though. We have over 40% of consumers continuing to tell us that high prices are eroding their personal finances, in spite of the fact that they have fully acknowledged and noticed that inflation has slowed.
What can we extrapolate from this about consumer spending or anything else in terms of consumer behavior?
Overall, consumers have been telling us all year long that the future of the economy is highly contingent on the election. And so the fact that the election has been resolved means that consumers are really starting to adjust their views for the future, which will allow them to plan and think more strongly about the kinds of purchases they want to make. Consumers have told us that their high price concerns for large purchases like durable goods, cars, and homes, those have all eased this month. And so things for them are headed in the right trajectory. However, they're still feeling, they're still not feeling as happy about the economy as they did prior to the pandemic.
Joanne, always a pleasure. Thanks for being with us today. And happy Friday. Joanne Schuler, Director of the University of Michigan Surveys of Consumers. Well, what would you like to hear on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg audience survey. Visit youtube.com/Bloomberg Podcast. Click on the link in our profile or community section to take the survey, which is hosted by our partners Material. Fill it out now at youtube.com/Bloomberg Podcast. I'm John Tucker, along with Emily Grafeo. Time to take a look under the hood right now. Some of the individual movers in today's market. And Carmen Reinecke, Bloomberg Equities reporter, joining us. What are you looking at?
Yeah, so the first thing I'm looking at this morning is ICANN Enterprises. That's ticker IEP.
That would be Carl Icahn.
Yes, indeed. Shares are down about 5.5% right now. It's actually paired pretty significantly. It was down as much as 11% earlier in the day. And what investors are reacting to is that it cut its dividend payout by half. So the dividend now is 50 cents per depository unit as opposed to $1 in the second quarter. And the reason that they're doing this is to boost their stake in CVR Energy Holding. This was already their biggest holding, and they're boosting their stake to 81% from 66%.
What about Airbnb? Are people feeling as confident about taking a trip as they are about the overall economy?
Yeah, the thing that's really interesting here is we've had two reports from different sort of travel-related companies with very different, at least stock reactions. So Airbnb, that's ticker ABNB. Shares are down about 9% right now. This is the biggest drop since August. The company actually reported pretty solid quarterly earnings, but they signaled an increase in spending may pressure earnings going forward. So I think that's what we're seeing impact shares right now. Their quarter showed that demand for bookings is actually pretty good. Overall, there's sort of not the big slowdown that people were expecting from the post-pandemic travel boom, and that I think it kind of goes really nicely into Expedia. So ticker EXPE, shares are up about 7% right now. They also reported earnings, and they showed that VRBO helped drive better than expected results in the last quarter. So this is sort of a turnaround in that sector for them, and it's really driving shares higher.
So Expedia and Airbnb are kind of competitors then.
Kind of competitors, but this all suggests to me, we heard from Joanne that consumer confidence is up, so we can safely say people are going to be taking vacations this holiday season or going away, right?
Yeah, I think so. That's really what we're seeing. There was also a great piece on Bloomberg this morning that linked in Booking as well. Their earnings and saying that, there really just isn't quite the slowdown that people were expecting. So Yeah.
Let's wrap up real quick with Pinterest, and I got to imagine advertising links into this.
Exactly. Advertising links in, you're totally right. Shares are down about 13% right now. That's ticker PINS, P-I-N-S. The thing that I thought was interesting here, so they gave a weak forecast for sales in the holiday quarter. That makes sense that it's weighing on shares, but specifically where the weakness was in food and beverage ad spend. That just caught my eye because I don't really typically think of Pinterest as a place where I'm looking for like food and beverages necessarily, but apparently, it's a significant enough sector to really weigh on the shares.
Thanks, Carmen. Appreciate it. Carmen Reinecke, Bloomberg Equities reporter. Well, Paramount Global, the parent of CBS TV, MTV, and its namesake Hollywood Movie Studio, reported third quarter sales that missed analyst estimates. Let's break it down right now with our next guest, Geeta Raghunathan, Bloomberg Intelligence analyst. Thanks for being with us. Shouldn't we really be focusing on streaming here?
Well, we should. I mean, streaming is making up only 25% of total revenue, John. But remember, they are in the midst, as most of the old media companies, Paramount is in the midst of this whole transition away from the linear TV model to the streaming model. And the reason we need to focus on streaming is because up until this point, streaming was really weighing on overall profitability. So we saw the streaming segment contribute to something like $2 to $2.5 billion in losses. And that was really pressuring overall company profitability. Now, what has happened now is we're finally seeing some signs of a turnaround. There's some signs of hope for the streaming business because for the second straight quarter in a row, Paramount actually posted a positive profit number. So that is definitely good news. The bad news, however, which is kind of causing a little bit of, the fall in the stock after the earnings call, is because they said that in the fourth quarter, they're again going to go back to some amount of streaming losses. However, the long-term view still is that, the streaming business, which is Paramount Plus, their streaming platform, will be profitable in 2025, at least in the U.S.
How does that stack up with Paramount's streaming competitors? I feel like these days you go and you turn on your Roku TV and there's maybe 6 or 7 different options for streaming. And I don't know if Paramount is, the first one that comes up on at least my suggested apps to click on.
Now, you bring up a very, very good point. I mean, there's absolutely no doubt that Netflix has won the streaming wars. They are the default go-to option. But when you kind of look across the board and you look at some of the other streaming services, Paramount definitely is there. Of course, they might not be your first choice as you kind of gravitate to streaming, but they definitely have a lot of content that people want to watch. So they have a lot of content from their linear TV platform itself, a lot of sports content. They're one of the streaming platforms that's pretty sports heavy with NFL, with UEFA. So people definitely like that. And then they have some pretty good scripted content as well, whether you're talking about Star Trek or Yellowstone, they have Tulsa King. So they have a lot of, good pieces that people want to watch. But you're absolutely right. When it comes to scale, and streaming is a game of scale, they're nowhere near Netflix or even Disney Plus. They have only about 70 million subscribers on their Paramount Plus platform. So obviously the competitive dynamics still working a little bit against Paramount. Having said that, though, I mean, not all bad.
What's the update with the merger with Skydance Media?
So the Skydance Media, I mean, of course, this was a merger, John, that was in the works for almost ever. It was going on and on, the saga. It is going to close sometime in the first half of 2025. And so we're seeing that a lot of the progress that the company has made in terms of cutting costs, in terms of new management team, some new capital, $1.5 billion that goes straight to the balance sheet. So all of those are definitely positives. But the hard truth is that the backdrop continues to be very, very difficult.
Well, is this the joint venture partner?
By Paramount for the longest time. And of course, their main interest was really in the studio, but then ultimately they decided that they could do something with the entire company and kind of give it more of this tech-driven focus.
Geeta, always a pleasure. Appreciate it. Geeta Raghunathan, the Bloomberg Intelligence analyst. And Bloomberg Intelligence is being brought to you by the Jewish Communal Fund. JCF helps you respond to crises swiftly. Open your JCF donor-advised fund now to secure your tax deduction. Visit jcfny.org or call 212-752 8277. I'm John Tucker, along with Emily Griffeo, and you are listening to and watching Bloomberg Intelligence.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. The S&P 500 Dow Industrials on track to deliver their best weekly performances in a year. Let's start with the Dow. Up about 0.5%, 219 points, 43,952. The S&P 500 up 0.3%, 17 points, 5,990. We have the NASDAQ, little change, down about 3 points at 19,265. Want to move to currencies. Right now we have the dollar edging higher, but want to point out the Chinese yuan. It is weaker, down about 0.6%. This is after China announced a $1.4 trillion program to allow local governments to refinance debt. U.S. listed shares of Alibaba right now down about nearly 5%. Bond yields, commodities also falling on that news. We have the 2-year yield at 4.20%. That's little change. The yield on the 10-year 4.27%, and that's down 5 basis points. Shares of Trump Media and Technology, well, they were halted for volatility. Now they picked up again. Right now, their shares are up about 7%. The reason why, President-elect Trump saying that he has no intention of selling shares of Truth Social. He's putting that out there. Revenge travel, not over just yet. Online travel giants Airbnb, Expedia, strong outlooks. We have Expedia up about 8%, but Airbnb down about 9%. Analysts flagging the impact of investments on margins. That's why those shares are lower. And today, NVIDIA, Sherwin-Williams joined the Dow, replacing Intel and Dow Inc. We have NVIDIA down 1%, Sherwin-Williams up 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. John
Lisa, thanks very much. I'm John Tucker, along with Emily Griffeo. We are in for Alex and Paul today. So what is the path ahead for the Federal Reserve after yesterday's 25 basis point cut? Daniel DiMartino Booth is the CEO and the chief strategist for QI Research. Good to see you again.
It's great to be here in studio in New York on this beautiful day.
Yes, on a Friday. Thank you very much for coming in. So what was your takeaway from the Fed meeting yesterday?
So we were speaking offline before I came on, and I think
I was prepping the guest.
Indeed. I think the version of Chair Powell who showed up yesterday was like the Dirty Harry version, extremely succinct, very few words. He wasn't scripted. He wasn't reading his answers. He wasn't nervous. He was expecting all of the political angles that the reporters were going to take, and he was ready for them, and he cut them off at the pass time and again.
So how are we supposed to make sense of the market action and what is driving? I mean, Treasury yields right now, we were also just talking about this, they've dropped about 16 basis points.
16 basis points on the 10-year in a matter of 2 days. In fact, the 10-year dropped 4 basis points the minute he was asked by a reporter that if you're asked to step down by President Trump, will you? And he said no. And so she rephrased the question, and he looked over his glasses and he said no. And at that minute, the 10-year yield dropped 4 basis points. So I think markets right now are celebrating continuity and steadiness, and the fact that I think the Fed's going to continue to cut rates. I really do see that as a path forward. I know a bunch of sell-side banks this morning have come out and said there are going to be much fewer cuts in 2025. As a 9-year veteran of the Fed, it's extremely rare for us to have seen the pause in the hiking cycle. It would be nearly unprecedented to see a pause in an easing cycle. We tend to see unemployment rates tick up in chunks, and we're just a smidge of a percentage away from the unemployment rate having been 4.2% in October, and we know that layoffs have picked up appreciably since September. So we can see what's coming, and I think Powell leaned on the employment mandate yesterday with good reason, and he said, I'm not making any decisions. There's 2 inflation reports, there's 1 employment report. Before we meet again, I'll let you know.
Can the Fed be at all preemptive when it comes to, it's not their mandate, but fiscal policy?
Well, the answer is no. When you land on day 1 at the Fed, you learn 2 things. You learn about the lag effect of monetary policy, which we're still seeing. I mean, BCY Go, pull it up. You've had 30 bankruptcies in September and October. Since 2000, your average 2-month average is 20 large bankruptcies. So pull up BCY Go on Bloomberg. But the second lesson you learn at the Fed is never talk about the dollar. Fiscal policy is the purview of the Treasury Department. Now, Powell said yesterday, if things begin to go haywire, I'm telling you right now, our debt levels in this country are way too high. They're absolutely untenably high. He said that.